You asked the question, where did all the bears go? And I think we know. The Fed shot them.
I think there's an uber amount of optimism coming out.
When we look at all of these markets, we're kind of priced for perfection.
Let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot more uncertain.
The question is, does the party stop? I think most folks think it doesn't stop.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The year feels over, but it's not. Welcome. Good morning. This is Bloomberg Surveillance from New York for audience worldwide. Alongside Katie Greifeld, I'm Lisa Abramowicz. Tom Keene, Jonathan Ferro both thought that the year was over, and so they left. But it is not over, very much not, considering the fact that we've got some key data coming up. So Katie Greifeld, I am so pleased to have you in the seat as we really parse through, yes, thin liquidity, but also some really big questions heading into the beginning of next year.
Big time. And of course, we're going to get some important economic data today. You think about what we learned last week from the Fed. Going to be interesting to see jobless claims and PC on the heels of that. But also yesterday, something interesting actually happened in the equity market at around 2:30 or so. Suddenly stocks puked. So, of course, thin liquidity, like you said, but shows that there's still nerves under the surface here.
Okay, just to put some numbers around stocks puking, because, it is still 6 a.m. in New York. We're looking at the biggest decline in the S&P going back to September. And this metric I thought was interesting. It was only 19 companies that eked out a gain in the entire S&P. So broad-based gain on the way up, broad-based sale on the way down. And some people are looking at certain options trades as the culprit. Is that sort of the mood on the street?
0-day options right now. That's the scapegoat there. Apparently there was really heavy put volume in particular, which could explain some of the very technical feeling moves that we saw, because there wasn't a really clear catalyst necessarily. Nothing happened at 2:30 p.m. I was paying attention, but like you said, of course, it was very broad-based. Felt like everything sold off at once.
Well, it's a little bit calmer this morning. I do find it interesting that the bond market did not participate in the puking. They were very much still getting a bid in, with actually a 92% chance now priced in of a March rate cut. So it still is this belief that the Fed, despite all their pushback, are going to come out, embrace the disinflation by paring back where rates are and giving an extra leg to what we've seen in markets.
It's really interesting how higher for longer turned into higher for a little bit. Now maybe we cut in March. Of course, we have seen some pushback against how soon these rate cuts are priced in from some of the Fed speak. But yeah, the broad-based consensus at this point is that sooner rather than later, the next move is going to be a cut.
Higher for a hot second. I find it interesting that we got a dip yesterday, and my first reaction is this a viable one? Because literally every single analyst who's come on has basically said, we're looking for some kind of turmoil. We're looking for some sort of volatility so we can buy, so we can have a better entry point. That has literally been the comment from every single person, the latest being Citigroup's Scott Cronert, putting this in an actual note, talking about the message is to expect pullbacks and buy into them. Does that mean we don't get pullbacks?
They're short-lived if we get them, but it is a good point. I mean, we think about 0-day options, et cetera, being blamed for what we saw yesterday, but it's important to note that you think about how overbought we were. You take a look at the RSIs, whatever you like to look at, and by some measures, I mean, the S&P 500 was the most overbought since 2020, so we've come really far, really fast. It makes sense that we'd hit some turbulence here.
Especially given the fact that we do have a host of issues on the geopolitics side, which we'll be getting into with respect to China, and a tit for tat that seems to be escalating between the U.S. and China on the trade side of things, as well as, of course, that Houthi militant attack regime that's really caused some consternation in the shipping sphere. What we're looking at in markets today is a bit of calm after yesterday's 2:30 p.m. puke, as Katie Greifeld said, and I'll stop saying that after that. That was our allotment for the day. We could see about almost a 0.5% gain on the S&P, 47.71, just off the all-time highs. Euro getting a little bit of a bid versus the dollar, 109.58. 10-year yields, this to me is the most interesting. Yes, they are inflected up 4 basis points today, but yesterday, a sharp rally. Yields lower on the heels of that UK inflation print, despite the sell-off in stocks, 3.88%. Katie, I did wonder, was this a growth concern starting to creep up into the price action, or was this just idiosyncratic technicals under the surface?
It's a great question. What is actually driving the Treasury market right now? Is it that traditional haven bid? Maybe some of those growth concerns coming to the surface, or maybe it's something else. Maybe it's just a reflection of Fed policy. But of course, it's known for certain that we firmly broke below 390. It feels like the question right now is, where is the floor when it comes to the 10-year?
And where are the buyers all going to be coming from? What we're watching today, 8:30 a.m. initial jobless claims come out. out, and this is sort of the latest tea leaf that people look for signs of weakness. We have not gotten it. Unemployment has actually declined over the past month. So here's the question. Do we start to see a greater sign of weakness, especially as we saw the likes of General Mills as well as others come out yesterday with some warning signs in their earnings releases? 1 p.m. presidential press briefing takes place, including National Security Council's John Kirby. Very curious to hear where the administration's mind is when it comes to the Houthi militants, what kind of action they will be willing to take, as well as sort of any updates on how they see that evolving. And before market, we do get a host of earnings, including from Carnival, and aftermarket earnings from Nike. To me, this is where perhaps the rub is going to come into place, Katie, because a lot of people, a lot of enthusiasm on the macro level. On the micro level, a bit more volatility in terms of the signals that we're hearing, the commentary from CEOs.
And it's a really nice pairing that we have both Carnival and Nike. Of course, you think about people really going back into experiences. Travel stocks have been on fire this year, maybe at the expense of some of those retailers selling physical goods. So a really nice juxtaposition to really tie a bow on that point.
Let's get the day started with Margie Patel, Senior Portfolio Manager at Allspring Global Investments. Margie, I want to start with, is your year over? Are you actually doing anything, or are you just sort of watching with a wary eye and counting the days until you can go on vacation?
Well, really, I think there's still some opportunities on days like yesterday to add a little when the market has a nervous day like that and just take advantage of that volatility. I think the market is going to return in the rest of the year and finish on a strong note. And I think, again, 24 is going to be a surprisingly good year for the market, to the frustration of so many people who have been looking for a recession.
Do you feel sort of vindicated, Margie? I felt this sort of sense of, all those people who've been calling for gloom and doom, you can keep feeling frustrated. Is there sort of a sense that people have been warning you and you've been pushing it aside and you've been right and you've seen things that they have not seen?
Well, I think that just looking at the fundamentals is really what's kept me pretty positive about the market. And I continue to feel that way. We've had 3 quarters of economic growth this year that have been, again, surprisingly strong. And it seems that most of the statistics are, again, surprisingly strong. And yet people are still looking for a big recession, a big correction in the market, because that's what history has told us we should have. So I think it's people are rejecting the facts and looking backward and expecting to have a big drop. We had a little drop this year, a quick drop here this year, a quick drop last year. Very difficult if you were out of the market to jump in and take advantage of those. So I think people are still hoping we'll have another big drop where they can maybe readjust their investments or get in the market. There's a lot of cash out there.
So, Margie, it sounds like what you're saying is that against this backdrop, with all that cash in money market funds, et cetera, that buy the dip, that mentality is really back in the forefront, or at least coming to it.
Well, I think that's going to be the right strategy to do. And the reason is because I think we're going to continue to have reasonably strong economic growth next year, even if it's 2 or 3%. I think that would still allow, say, the Standard & Poor's to be up, say, 8, 10, 12%, something like that, which would be a reasonably attractive rate of return, especially if the Fed is beginning to lower short rates, making money markets a little bit less attractive for the investor.
Well, let's talk a little bit more about the relationship between the equity market and the bond market right now, because as Lisa and I were talking about, you take a look at 10-year yields firmly below 390. We were at 5% not too long ago. I take a look at your notes that the 10-year yield should remain between 425 and 525. It feels like we're a far way away from even the low end of that range. Should we get back there? Is that any hurdle to the equity market? How are the two working alongside each other?
No, I think even a higher rate above 4% wouldn't really be an impediment. And the reason is because when you look at the economy, business and consumers, neither of those big sectors are over-leveraged. There's no sector you can look at in the market and say, oh, they're a very precarious position. They're likely to fall and have a cascading effect in the whole economy. So business consumers look pretty good. And so I don't think that we're going to see any slowdown in a continued modest recovery.
In this paradigm, Margie, do you still like stocks over bonds in a big way?
Yes, I do, especially because when we've had the 10-year go from 5% to under 4%, you've taken a lot of the performance out of that sector of the market. I think that there's still some attractive opportunities in the high yield sector. That's another sector people were worried about because as we go into a so-called recession this year, we should have had spreads gap out. They never gapped out. They actually narrowed. But I think with defaults probably remaining 4% or lower for corporate bonds and the Fed beginning to cut short rates, economy growing, I think to get, say, 400 basis points over treasuries looks pretty attractive for an income-oriented investor.
I want to talk a little bit more about the equity market and where you see opportunity there, because one of the breakout stars in terms of sectors has been the chip makers this year. Of course, we got Micron results after the bell yesterday. Being received pretty well by the market. You take a look, currently up about 5% or so in pre-market trading. Can that momentum continue into 2024?
Yes, I think so. We like the semiconductor sector. It's been a volatile sector, but a great total return vehicle. And a lot of those names these days, as opposed to previous cycles, actually have dividend yields that are actually competitive with other stocks. So we think they're a good all-around choice. We think there's strong secular growth for that sector, and we think that'll continue in 2024. Even if we just have, say, 2 or 3% GDP growth, we still like the sector.
That's a good point. You don't often think about dividends with semiconductor stocks, but as you say, pretty robust there. Does that feeling, that optimism about semiconductors extend to growth stocks more broadly?
Yes, I think with relatively modest growth, and particularly we're going to be, I think, one of the growth leaders. I think most of the emerging markets and Europe look as if they're going to be very, very muted, 0 to maybe 1%, nothing too exciting there. So I think it's really the U.S. economy that's going to be one of the best performers. So again, we think that it's a selective market favoring growth stocks over maybe some more value-oriented stocks, as has been the theme for the last year or so.
Margie Patel of Allspring Global Investments, thank you so much for being with us. The latest to say, yes, all dips are buyable, and yesterday was just one of them, which seems to be, frankly, the theme of the day. That
buy the dip mentality was sort of a hallmark of the pandemic-era stock market. Maybe it's coming back right now, but she makes a really interesting point. We've been talking about this broadening out of the rally. That's really been the theme of the past couple months, but Margie Patel's view is that growth over value into 2024.
Yeah, we've been hearing that from a number of people. There are a couple of things that have been catching my eye recently, in addition to the geopolitics that are sort of the overhang that a lot of people are watching. It's how different countries are dealing differently with the fact that inflation has caused a real decline in sentiment, notwithstanding the consumer sentiment survey that came out yesterday that showed actually a great deal of optimism. In South Korea, they have shrinkflation police. This is a Wall Street Journal story that caught my attention this morning, where there actually are people that go around to measure how much is actually being sold at any given time.
That's amazing.
For the price. And this comes as the head government is in a whole host of problems, but people are going around shaking the potato chip bags to see if they're kind of empty. But it just raises this point of people are feeling this dissatisfaction, that they're paying more and getting less, and how different governments are dealing with it, I find really fascinating.
Shrinkflation, greedflation, too, is very top of mind. That's one of my favorite buzzwords to come out of this year. And it's real. I mean, you think about some of these consumer retailer type of companies, the level of their prices have gone up so much on their goods. When does that turn into deflation, not just disinflation? Do they ever start to lower prices at this point?
And we've seen it in certain industries, right? We saw it in the airline industry briefly for a hot second over the summer, particularly on domestic routes. We have seen it in certain goods, but it's a good question. When do people start saying, okay, companies have been doing so well, it's becoming a problem for us because you guys are actually having really good margins even as we struggle with higher prices. Coming up, we're going to hear from Stuart Kaiser of Citigroup, who has been pretty bullish. He is very key on good news is good news and bad news is bad news, and stop having that discussion. We cannot wait to speak with him as we head into a new year. Right now, a little bit more of a lift. S&P futures climb further, up 0.5%. This is Bloomberg.
In the conflict between Israel and Hamas, we will continue to focus intensely on our core priorities. It's clear that the conflict will move and needs to move to a lower intensity phase. And We expect to see and want to see a shift to more targeted operations.
That was U.S. Secretary of State Antony Blinken delivering his end-of-year press conference, addressing the current state of the Israel-Hamas war at a time of escalating conflicts and real question marks over what can actually get passed, given the fact that Congress is really in gridlock when it comes to a whole host of number of issues that are being tied to financing. This is Bloomberg Surveillance. Tom and John ditched me as they get ready for their year-end holidays. Katie Greifeld did not, and I'm so pleased to say that you are alongside me. And honestly, this is one of the reasons why I've been surprised at some of the optimism, just because the geopolitical backdrop is pretty striking, pretty daunting right now.
Absolutely. It feels like it gets more complicated by the day. The Red Sea, obviously, a very intense situation, quickly evolving, too. And you think about also the macroeconomic implications. It feels like supply chains have finally normalized from what we saw from the pandemic. It's not in every single story every more, but obviously entering the forefront once again.
And it raises this question for President Biden. Is the economy going to be the main issue? Is disinflation going to help him when prices are still going up? Isaac Boltansky, Director of Policy Research at BTIG, joining us right now. And I want to start there with the polls. A latest poll out of Quinnipiac showed Biden and Trump basically neck and neck here in a dead heat, with a potential third-party candidate, Kennedy, coming in, gaining an increasing amount of the share. How much angst is there right now among Democrats that Trump is looking more and more likely to be the president?
Look, I think that both DC and the market are slowly coming to terms with the fact that despite everything that they might have hoped or might have thought, it's looking like it's going to be a Biden versus Trump rematch and a true head nod to the gerontocracy that we have currently in our government. And it looks like it will be those two against one another, despite many people hoping that there would be support that would coalesce around another Republican candidate, or perhaps President Biden would step aside and point to someone else to take over. But it looks like it's going to be those two. And that's incredibly meaningful because, look, the last election was decided by about 40,000 folks in 3 states. And so you put those two back on the ballot against one another, and then you add the third-party candidates. And this becomes an incredibly close election, as evidenced, from my seat by the 7 swing states that are going to decide this, all showing Trump ahead in the most recent round of Wall Street Journal polls.
Isaac, can we basically write the obituary on the idea of another candidate taking the former President Trump's place, given the fact that in this latest poll, Donald Trump widened his lead to 67% among Republicans, and that compares to about 11% with Ron DeSantis as well as Nikki Haley?
Yeah, look, when we think about the structure of our political system, you think about areas that perhaps are ripe for reform. I think the primaries are one of them, because the primaries skew either to the far left or the far right. And within the Republican primary voter base, about a third of those individuals are with Trump forever and will stick by him through thick and thin, as shown by the indictments and everything else. And since a lot of these primaries are moving to a winner-take-all structure, that means he should be able to cruise. And it's one of the problems that you've seen with Democrats as well, with some of the farther left ideas gaining more and more traction. So it's the primary structure in and of itself that pulls the parties to the extremes.
Isaac, I want to talk a little bit more about third-party candidates. Of course, there's some of them in every single presidential cycle. It does feel that this time we're hearing a little bit more about them. Of course, the likes of Robert F. Kennedy Jr. really making waves. But do third-party candidates, do they become anything more than just a conversation point in 2024?
Look, my overall framing for this is that about 1 in 10 Democratic voters say they're open to considering a third-party candidate. But look where we are in the calendar. You got a lot of road between here and November of next year, and I think that number will be reduced. My cautionary point is, let's not focus on the broader polls. Let's not talk in the aggregate. It's going to matter in certain states, right? I'm going to see how RFK is playing in states like Georgia, like Pennsylvania, like Arizona, any of the other swing states that we have there, North Carolina in particular. That's where it's going to matter to me, is those 7 swing states. That's where a third-party candidate could have an impact at the margin and overall influence who takes the Electoral College home.
Well, let's continue talking about specific states, and let's talk about Colorado. Of course, the news this week, former President Trump being basically kicked off the ballot in Colorado. It seems like each one of Trump's legal challenges thus far have only served to galvanize his base, so to speak. Is that going to be the case here as well?
Yeah, look, I mean, this is the broader point that I think we should keep hammering home. Every indictment showed President Trump's polling get a small boost, depending upon which one you look at. And with this Colorado decision, which we should highlight, was a decision that was 4-3 in Colorado relating to the 14th Amendment. That is something that I think will even further galvanize the Trump base. From a practical perspective, though, I think it's pretty limited in its impact. This is something that's going to be heard by the Supreme Court. Most of the folks I talk to think that Colorado's reasoning in this case will be rejected. But the Supreme Court is going to have a very political year, right? We've got to keep in mind they're probably going to hear this. They're already hearing a case relating to whether President Trump was immune because he was president. They're going to hear cases relating to the January 6th rioters. So the Supreme Court's already in a bit of a politically precarious situation. That's only going to intensify as the year goes on.
Isaac, how do people trade this, given the fact that we have no idea how things are going to transpire next year, and everyone says there's political risk? What does that mean?
Yeah, look, I mean, the year ahead note exercise a lot of us have to do is such a silly exercise, right? I mean, look, beginning of October, Kevin McCarthy was speaker. We also weren't talking about Israel, Hamas war, right? So who knows what's going to change in 3 months, let alone 9 months. But what we try to do is try to frame the winners and losers at the highest level from a Republican White House and a Democrat White House. And there are acute themes that you can really sink your teeth into if you do believe that Republicans have a decent shot. And here I'm talking about things like seeing more M&A activity, because you will move away from hipster antitrust thinking that you've seen at the FTC and the DOJ, rollback of some of the big bank capital proposals, things like getting Fannie and Freddie out of conservatorship will be on top of the ticket. So there's certain acute themes that you can sink your teeth into that I think are worthy of consideration as we get ready for what's going to be a long and frankly exhausting campaign season.
Isaac, sorry, just to rewind, did you say hipster antitrust? What is that?
Yeah, so whether you call it New Brandeis or hipster antitrust, it's the expanded school of thinking around antitrust and competition policy that's been advanced by FTC Chair Lina Khan, among others, which is basically a broader framing of how they should think about consolidation and trying to move away from the consumer harm standard that has really been the backbone of consolidation theory since the 70s.
Isaac Boltanski of BTIG. Thank you so much with hipster antitrust, which I guess there is this popularized idea of sort of an inherent ill when companies get too dominant. And this is coming at a time when you have the big getting bigger. I mean, that has basically been the story of the past couple of years.
Big time. And of course, the FTC under Lina Khan has made some really interesting moves, taken some big losses, but also had some big wins. But I just like how woke politics, it seems to come for everything. Antitrust.
I don't know if it's woke. I just think that, yes, it's definitely there are popular kinds of spheres of thought. Coming up, we're going to be speaking with Gilles Moek of AXA as we deal with some of the economic data. You mentioned the PCE data that comes tomorrow, especially on thin markets. That could be really interesting given how much this market's leaned into disinflation.
Oh, yeah. And you think about it, if it's a surprise in either direction, given how firm this market seems to be in its belief that it's March, we're going to get that first cut from the Fed, it could make some waves. And we saw what happened yesterday afternoon. We know that liquidity, that volume right now is pretty thin.
Do you buy into this whole 0-day
I don't know.
conspiracy?
It seems like a very convenient boogeyman. I want to read some more academic studies on it.
I want to know, all the people who are buying this morning, you do see a lift to the market as people do come in to buy the dip, just as we heard Marky Patel looking to do, and Scott Cronert over at Citigroup up a lift about 0.5%. 47.71. Yields really interesting, remaining below 390 on the 10-year, 388. 3 hours to the start of the U.S. trading day, we can see a little bit of a lift after yesterday's sell-off, which was the worst sell-off going back to September, with all but 19 stocks in the red. The broad-based increase is a broad-based decline. This morning, not so much. We're getting a bit of a reprieve. The buy-the-dip moment, perhaps up about 0.5%, 47.72. And you can see across the board that lift. Russell 2000 getting the biggest lift, and I find this interesting. Katie Greifeld here alongside me. John and Tom both took the day off, well-deserved vacation, and they'll be off through the end of the year. I am interested in the fact that the Russell 2000 keeps on outperforming, the sort of hope, the white hope that it will be the one that will really lead things off next year.
And we'll see, because, I mean, you take a look at the chart really over the past 2 months, and it's just been parabolic, this rise in the Russell 2000. I will say on the S&P 500, even with yesterday's puke technical move lower, of course, you're seeing that buy the dip today. And we are in spitting distance still of a record high. We know the NASDAQ 100 has already gotten there. The S&P 500 still not there, but we are inching closer and closer.
I'm laughing because there's a lot of, bodily functions going on.
It's just what
I know. It's true. There's
That's
a lot
how we talk in the afternoon,
I understand. But in the early morning, we try to keep people's breakfast.
Of course,
I'm just saying, you have to understand, we are seeing in the bond market, it has been a bid in. We can see a bit of a lift in terms of yields going a little bit higher. But still, the fact, and you pointed this out, Katie, the fact that 10-year yields still solidly below 390 and 2-year yields up 437. I mean, just the incredible round trip at a time where people are pricing in a 92% chance that the Fed's going to cut rates next year tells you, starting March, tells you kind of how much a mood has shifted.
And then you think about the dynamic of the curve. Of course, the 2-year yield still firmly above the 10-year yield. If we finally do get those rate cuts, if they are pulled forward, maybe March, maybe that's the dynamic that leads us back into positive territory on some of those yield curves.
Or maybe it's just that we start to worry about the deficit again, considering that Washington, D.C. will become very much front and focus next year. In the election season, in currencies, we do see a little bit of dollar weakness, everything else kind of gaining, including the euro, 109.70. It's really kind of flirting up against 110. Again, this comes at a time where the ECB is saying that they do not plan to cut rates. They plan to hold things steady at the same time that the data doesn't confirm that, whereas U.S. officials are kind of embracing this idea of rate cuts. Under surveillance this morning, a possible media merger on the horizon. Bloomberg reporting that Warner Brothers Discovery and Paramount held talks about a deal to combine two of the world's biggest media companies. The talks are preliminary, but Axios reported that the CEOs of both companies met in New York this week. Warner Brothers shares up about 1.1%, Paramount Global unchanged. Katie, to me, a very interesting tie-up. HBO on one hand, and all of those CNN, not CNN, but a whole host of other media outlets. Is it for the content?
That's the big question here. It seems like that's the motivation of this, what would be a massive tie-up. And given the size of these two companies and the combined entity, how large that would be, the knee-jerk reaction is what kind of regulatory scrutiny is this going to run through? Is it pointless to even talk about? Will it even get off the ground? Of course, those are some big questions hanging over this.
It also is, honestly, something everyone's been talking about, which is there needs to be consolidation in the media space at a time where people are taking a look at their streaming bills and saying, what happened to the bundle? We kind of liked it. I mean, seriously, how many subscriptions do you have to different media services?
At least 10, probably.
Right. And if you're paying $8 a month?
I don't like to think about it.
I know. This is the reason why I think they get to keep doing it. Although, when the price increases come down the pike, maybe people start to cancel things.
The deflation finally kicks in.
Exactly. China, meanwhile, set to halt exports of a number of rare earth technologies, ramping up competition with the U.S. for strategic raw materials. The decision will impact materials involved in everything from wind turbines to military tech to electric vehicles. China accounted for more than 2/3 of mined rare earths last year. It holds around 85% of global refining capacity. This according to U.S. government officials, and it comes at the same time that the U.S. is talking about the mother of all sanctions if China were to attack Taiwan in some capacity. At the same time, when we're hearing reports that Biden is thinking about possibly increasing tariffs on electric vehicles from China.
And you think about where these U.S.-China tensions are really playing out, both in the flow of goods, but also the flow of raw materials, such as the rare metals that we're talking about. And the U.S., you think about the U.S. side of things, this is China's move today, but President Joe Biden, he's really been trying to generate more of this supply domestically. But you think about the huge role that China plays and has played for decades. It's a long timetable.
Especially if they have the raw materials, right? Yeah. And this raises this real issue. Where else are you going to get them? and who is sort of a worthy partner as the U.S. tries to shift more to electric vehicles and some of these other renewable energies. Meanwhile, after a week of pushback from Fed officials in the rate cut trajectory, Philadelphia Fed President Patrick Harker saying the central bank should begin to cut interest rates, saying, quote, "It's important that we start to move rates down. We don't have to do it too fast, and we're not going to do it right away." Basically, we're in. Harker's comments coming ahead of the latest read on the U.S. labor market with jobless claims due in about 2 hours. I love it, Katie. They kind of try to push back. No one listens. They try to push back again. No one listens still. And they're like, all right, you're right. We're going to cut rates.
Yeah, and it is important to note that, I mean, Harker, he won't vote on policy next year. But in this environment, again, with convictions so high in one direction, every single scrap of Fed speak is being parsed at this moment.
The thing that frustrates me is, does it really matter if they cut in March or if they cut in April or if they cut in May? I mean, essentially, if they cut the same number of times or if they are having the same parameters of cutting just in terms of disinflation coming down, then does it really matter how much or when, right? Are people getting a little carried away with that? And is the Fed trying to push back on that? But does it even matter to the price action that we've gotten? Because essentially, if the Fed is showing a willingness to try to adjust their restrictiveness to allow for a soft landing, doesn't that completely change the paradigm from people who are worried about the Fed killing the rally?
I think that's a great point. What's the difference between a month or two? And also, will rate cuts really, really matter for this market? It feels like rate hikes, 500 basis points of rate hikes didn't really matter. We're looking at potential records on the S&P 500. Will rate cuts matter, or is that just an excuse to rally?
Let's ask that to Jill Moek, AXA Group Chief Economist and AXA Investment Managers Head of Research. Let's go there, Jill. Do you agree that rate cuts really matter in terms of easing financial conditions, considering that on the way up, each hike didn't seem to materially tighten financial conditions?
Well, yeah, the question may be whether this loosening in market conditions is not happening too fast. I mean, I constantly look at market pricing for 10-year yields in the U.S. in real terms. For instance, they are barely at 2% now. The spread on corporate bonds has actually tended to narrow recently. So my view here is that, yeah, maybe it took more time than usual for financial conditions to get to where they should be to tame inflation. But the speed at which they are correcting right now makes me think that the market is getting a bit ahead of things, to the point that it could actually make it harder and not easier for the Fed to be accommodative next year. Because if the market goes too far on its own, then the question will be, what more does the Fed need to do to make financial conditions more palatable? So there's a loop, there's a dialogue between the market and the Fed. And honestly, at the moment, I'm wondering if the dialogue is getting us to, let's say, a reasonable position.
I want to talk about financial conditions a little bit more and how one should actually measure them and how the Fed is doing that, because you have these market-based measures of financial conditions which show pretty significant easing, especially over the past 2 months with this risk asset rally. But I feel like we've heard from Jerome Powell and others that really the thing to watch is real yields and the direction of travel there. What do you look at to judge financial conditions?
Well, there are many yardsticks, but a very simple one, which I've been using for a long time, is to look at where 10-year yields are in real terms relative to what is probably the U.S. potential GDP growth rate, which consensus has it at around 1.75%. So when you get real 10-year yields getting close or below 2%, it's getting hard to say that financial conditions, at least across the curve, are still in restrictive territory. We are flirting, basically, with neutral financial conditions if you use this very simple yardstick.
And if we are flirting with neutral financial conditions, what does that translate into in terms of rate cuts? Does the Fed necessarily have to ease so aggressively as the market is pricing in if we are indeed near neutral territory?
Yeah, that's my point. I think there's something a little bit hard to reconcile right now in how the market is pricing the trajectory for monetary policy next year. Because if for the Fed to cut by as much as what the market is right now, you probably need to be in a situation where precisely financial conditions would remain far too restricted, and where the economy would probably need to be much worse than what the consensus had. There's something which doesn't add up to me. to get to the kind of rate cuts that the market is pricing right now, you probably need to be in a situation where there will be an outright recession in the US. That's not what the market is pricing. If you believe that there's going to be an outright recession in the US, then yes, probably current financial conditions are still too restrictive. But if you believe that it's going to be a soft landing, which seems to be the consensus right now, then, as I said, financial conditions today are probably already pretty neutral.
So you don't believe in the transitory story?
Sorry?
You don't believe in the transitory story, that really inflation actually was transitory, it just took longer than expected, and it will continue to go down just simply as a year-over-year comp and supply chain resolution issue?
I'm possibly overcorrecting because initially I was in the transitory camp. It took me time to acknowledge that, yes, we were faced with persistent inflation. So that probably makes me a bit reluctant to say today that, yeah, it's fine. Inflation is going to normalize on its own. So we all learn from our past mistakes, and we probably tend to overcorrect. But I still believe that the burden of proof should be on making sure that inflation is going to go all the way to 2%. And it's not that clear today. I know it's a very simple view, but if you break down core inflation in the US between durable goods prices and services prices, you still have an acceleration in services prices excluding rents. And that is normally the expression of the domestic engines of inflation. So it's very hard for me to say right now, it's fine, all the engines of inflation are switched off, things are going to very nicely glide towards 2% without much additional effort. It's possible. My own forecast is that, yes, we will get to 2% inflation by 2025, but not with the kind of financial conditions which is currently priced in by the market. Because if we go that fast into recreating traction for the real economy, I'm not sure we'll have the slowdown in job creation that we need to see for services prices to really decelerate.
And this is why a lot of people are worried about inflation reigniting. Gilles Moek of AXA, thank you so much for taking the time as markets do run away with the idea of rate cuts next year, now pricing in 6 rate cuts through the end of next year. I do wonder, Katie, when you look at the disinflationary narrative, how much has secretly been driven by lower oil prices?
That's the thing. I mean, I know that there's plenty of ways to strip out the impact of oil, et cetera, all the various measures of core. But you think about how people feel inflation, what actually informs inflation expectations. It's food prices, it's oil prices, how much it costs to fuel your car, how much it costs to heat your home. And I think that just feeds into everything.
Yeah, especially given the fact that that's transportation costs. That's when it comes to, just sort of driving to work. That's sort of the goods disinflation side. Although that said, we did hear even from General Mills and others yesterday that they are seeing less demand. So again, it's just a hard economy to kind of parse through to understand where the drivers are going to come from.
I mean, you go back to what we heard from the Walmart CEO, I forget when that was, it feels like a month ago, saying to expect deflation next year, at least when it comes to the specific segment of the goods that Walmart is selling. But it's going to be interesting to hear from more of the C-suite at some of these big box retailers and beyond about what they're expecting in terms of their own pricing.
Yeah, definitely something that we keep talking about. Coming up, we're going to be speaking with Richard Fishman of MoffettNathanson on talks between Paramount and Warner Brothers Discovery. I do want to bring this to you, just sort of confirmation that China does plan to halt the export of a range of rare earth technologies. This coming as a tit for tat escalates. We'll be having that conversation coming up as well as we try to understand what the implications are at a time that's highly fraught with geopolitical conflict. Right now, we could say oil prices a bit lower, stable, with a lot of people wondering why they're not responding more to the Houthi militant attacks on carriers going through the Red Sea.
There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years. Obviously, you have an FTC, which has been allergic to consolidation. That, of course, may change, but it's inevitable.
That was, of course, Chris Marenghi of Gabelli Funds predicting consolidation in the media industry when he joined us about a month ago. If you wanted to know, the media industry is consolidating. We yesterday learned that Warner Brothers and Paramount held talks about a possible merger, deal putting potentially the studios together and putting HBO and CBS under one roof, according to people familiar with the matter. Robert Fishman, senior research analyst at MoffettNathanson, writing this morning, "We hesitate to see the upside in any transaction for the Paramount company as a whole, especially at its current premium valuation, given the pressure on the linear TV business." It's a great place to start. And Robert, I'm so pleased to say, is joining us now to discuss. Robert, that is my key question. What is the advantage to tying up CNN and CBS?
Well, good morning. Thank you for having me. I think the answer to the question right now is the desperate times in media landscape, and the companies are facing significant challenges from a linear TV perspective, given the increasing rates of cord cutting. Linear advertising, we think, is in secular declines right now. So all these companies are looking to really just cut back. And back to your conversation earlier, try to figure out how to get to this other side of the streaming pivot that they're all making. But it's a really challenging time right now.
So do you think that this is a viable deal, or do you think that this is just basically the CEOs throwing in the towel and saying, we'll talk to whoever we can to try to understand what could potentially work?
I think every company is really trying to figure it out right now. And I do think that combinations are likely to happen. Do I think that anything is going to happen in the very near term? We have our skepticism just because of the regulatory landscape that was just referenced.
And something that I've been wondering about, thinking about this potential combination, is how Warner Brothers would actually pay for this. Because as I understand it, they have a pretty hefty debt load. You think back to that massive merger between Discovery and Warner Media from 2021. How would they actually fund this acquisition if it happens?
Yeah, we're still waiting to learn more details in terms of the actual terms and how it would be structured. I mean, clearly that they would likely look for some sort of stock component, if not a significant stake in the combined companies. So we still need to figure out the exact combination. But to your point, all of these companies are in a challenged position right now because of the debt loads that they have. And that has limited the flexibility that these companies have as they're coming through the streaming pivot that they're looking to make and trying to get to the other side with the pressures of the linear ecosystem going against them.
And if I were in the C-suite at Netflix or, say, at Apple's streaming arm, should I be worried right now? Not particularly just about this potential tie-up, but potential consolidation to come?
Well, from the digital company's perspective, in terms of streaming specifically, I mean, clearly, I would flip the question around and I'd say the media companies should continue to be worried to see how much bigger and stronger the digital companies are getting in streaming, especially with public reports that Amazon continues to be looking to go more in sports. And I think the whole sports angle here is a really interesting angle because what Warner Brothers Discovery does not have today is a broadcast network. And what we know that they're looking to do, a big deal coming up in 2024, is going to be the NBA renewal. So sports, I think, is a critical piece to all of this potential consolidation question, and how that plays out and who owns what assets will be have a significant impact on the future of the sports landscape as well.
That's exactly where I was going to go, especially with CBS. I wonder how much that's part of this idea of trying to get in, especially before Amazon, as they bid on this. If Amazon or one of the other streaming networks were to get a hold of some of the rights to the sports teams, or football in particular, would that be the death knell for the cable channels?
Well, to some degree, it's already happening. Amazon does have their Thursday night package, and they've succeeded so far this season. We've seen real momentum there in terms of viewership. So yes, I mean, this is the trend for sports. Sports is going over the top. Clearly, ESPN remains the pivotal piece to the sports ecosystem. And there's been lots of discussion in terms of the timing of when they're going to take their flagship network over the top as well. But all of these sports rights are a critical piece, again, to the future of the media landscape and to the whole sports ecosystem. And the digital players play a critical piece as part of that as well.
I have to say, as you're talking, Robert, it does not sound very optimistic for a lot of these streaming channels that are not Amazon or that are not Netflix. And I'm wondering if the best game plan, according to you, is just to basically put all of the sort of repertoire, all the different shows together, give it as a streaming offer that is only one stream, it's a bundled stream, and just offering it like that rather than trying to compete in any kind of material way with the content as well as just the pocketbook of some of these other players.
I mean, we do think that reaggregation on the streaming side is inevitable. It will likely take some time to play out, but this potential consolidation or whatever permutation you want to throw out there is all one step closer to that end goal.
And let's talk a little bit more about Paramount specifically, because it was interesting to see this news yesterday about Warner Brothers. When you think about what else we've heard and learned about Paramount this week, of course, holding talks once again about a sale of the Black Entertainment Television Network, for example. We'll see if any buyers emerge there. Can Paramount stand alone as a standalone company? If it's not Warner Brothers, for example, do they need to be acquired by someone else at this point?
Yeah, I mean, I think the challenges at hand are real and growing. We hosted a conference a couple weeks ago now in terms of the future of the impact of charter deal, the Disney charter deal on the rest of the ecosystem. And we believe, and it's been reported, that charter deal with Paramount is coming up. But all future renewals for Paramount, given what we say, essentially back to sports, that the fact that they're leaking all of their premium sports rights, including the NFL, over the top is going to be a significant challenge going forward for Paramount. And we think that the renewals will come under pressure because of that. And that will be another leg as far as what some of the risks are facing this company. Coming back to the advertising story, it's a real difficult time right now. And it's pretty clear to us that television is in secular decline in terms of advertising. And that's going to put another significant challenge ahead, given how high margin these dollars are and the exposure that the TV networks, TV media business is for Paramount is generating essentially all of their profit today.
And of course, the talks between Warner Brothers and Paramount, they're preliminary, according to people familiar, may not lead to an agreement. But let's say that it did, that these two companies did combine. On the surface level, there's a lot of overlap between these two companies. What could that potentially mean for restructuring and layoffs, for example?
I mean, there would clearly be significant cost synergies involved in the combination of these companies. But in the report we published this morning, we alluded to the fact from an overlap perspective that the cable network business would be something with high concentration. So that's clearly something from a regulatory standpoint that we would imagine is reviewed at the very least. Again, in this potential speculative type of combination. And then you have to question what ends up with the two different studios. Whether or not Warner Brothers Discovery would be forced or even opportunistically look to get rid of the Paramount studio as well.
Robert Fishman of Buffett-Nathanson, thank you so much for being with us. Katie, I thought you brought up a great point about the debt and why this is sort of one of the key issues and obstacles to getting a deal done like this. How do they pay for it, given that they already have pretty significant debt loads right now? I'm looking at Warner Brothers, and the total debt is something like $45 billion.
It's a lot. That is a chunk of change and then some. But this is really David Zaslav's MO, growth by acquisition. Maybe a little bit surprising that we're pursuing another huge acquisition here just 2 years after what we saw with Discovery. But at a certain point, you think about how much debt, $45 billion, going to create some really interesting thought exercises for how this potentially would work.
Especially considering that both kind of need each other to get enough critical mass to be able to survive. We'll be talking more just generally about the mergers and acquisition landscape coming up, especially considering that this year, I think, was the first year in a very long time that the total acquisition amounts was something under $3 trillion. I mean, it was a pretty sluggish year. It should be more active, especially as companies realize that it's kind of now or never as we head into the next phase of the economic cycle. Coming up next, we've got Stuart Kaiser of Citigroup with some really interesting thoughts of how to play a rally that has absolutely been turbocharged into year end.
You asked the question, where did all the bears go? And I think we know. The Fed shot them.
I think there's an uber amount of optimism coming out.
When we look at all of these markets, we're kind of priced for perfection.
Let's just enjoy this calm right now, because I think it's going to get a lot rockier and a lot more uncertain.
The question is, does the party stop? I think most folks think it doesn't stop.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What was yesterday? How did we understand some pause in the rally that was rip-roaring until a sudden dramatic swoon? Do you blame some sort of boogeyman? Do you just say it's people packing up their bags and going home? Welcome back. This is Bloomberg Surveillance from New York City, live on Bloomberg TV and Bloomberg Radio. Tom and John are both off today. They started their year-end festivities early. I am so pleased to say Katie Greifeld alongside me. I'm Lisa Abramowicz. And really, how much can we really glean from yesterday's sell-off that was the biggest going back to September?
Not a whole lot. I mean, as you pointed out a little bit earlier, you didn't see any reaction in the bond market. It really held on to its move that had started earlier in the day. So that obviously tells you something. The fact that we were very overbought on a number of measures tells you something else. And the fact that it happened at about 2:30 p.m. on December 20th also tells you something, that there just weren't a lot of people around to be trading.
Yeah, I do wonder how many people were just sort of selling out before they went on vacation. This does come at a time where pretty much everyone is optimistic. And if there is a dip, you buy it. That is essentially the word that we're hearing from Steve Kroner over Scott Kroner, over at Citigroup, saying, we do expect some volatility, buy it. We've been hearing that from pretty much everyone. Does this basically set up for a risk case of people not being optimistic enough heading into 2024?
It's a great question. I mean, you think about the consensus of optimism right now and how that evolves. Of course, we do get some important data points just in the next 24 hours or so that will inform some of that heading into 2024. But I found a reason to care about what we saw yesterday. As of right now, over the past 3 days, the S&P 500 is actually down. Of course, we've seen 7 straight weeks of gains. If this loss holds, and of course, looking at the pre-market trading, there is some optimism coming back, that would be the first weekly loss in quite a while.
You did very well there.
I found it.
You found the reason to care. That would break the 7-week streak that was the longest going back to, 2021?
Yeah,
I believe.
Feels like it.
So it's been definitely a streak to be broken. I think that's actually really good. You did really well.
Thank you.
8:30 a.m. we do get some data. Initial jobless claims come out. 1 p.m. we get a presidential press briefing with NSC's John Kirby. And before the market, we do get earnings from Carnival as well as aftermarket earnings from Nike. And to me, this is what I'm watching, frankly, is just what the corporate commentary is, given the fact, Katie, that we saw yesterday a number of companies warn about the macroeconomic landscape. We heard FedEx come out and talk about that. We heard General Mills talk about that. We've heard a whole host of others. So at what point do you start to listen to them just as much as you've listened to all of the economic indicators painting another picture?
Exactly. Of course, we're talking about anecdata when it comes to commentary from some of these big CEOs, but it's very, very important. You think about the view that they have on the consumer, the state of spending in this economy. I got to say, I am very excited for Carnival because you talk about optimism. There's a lot of optimism that's been priced into Carnival shares up, 124% in 2023. It's just amazing.
Carnival, the cruise line.
Yes.
Okay.
Yes.
Meanwhile, Citigroup is one of the most bullish banks heading into 2024, calling for the S&P 500 to reach 5,100 by year end. That used to be one of the most bullish calls. Now it seems like it's part of the crowd. Stuart Kaiser, head of U.S. equity trading strategy at Citigroup, joining us now. Stuart, I want to start there. Do you sort of worry that you're not getting bullish enough because the rest of the street's coming to you?
It's a good question. I mean, I'm definitely feeling more bullish post-Fed, I think, than we were going into the Fed. I mean, as you know, we've been kind of bullish, the last few months, expected a rally into year-end. The Fed feels like they've extended that window a little bit, just in the sense that they're being more respectful of the dual mandate and probably a little bit, quicker to come to the rescue, so to speak, if we do see weakness in the growth data. So, I think we're probably, I don't know if we're more bullish, but I think the bullishness is probably has a wider window to perform in going into 2024.
Well, the reason why I ask that is because if we're at 4,800, essentially, you're not talking about that big of a gain through year end. And this comes as you're expecting the economic data to come in strong and to still show this disinflationary trend. So what would it take for you to boost that year-end target?
Well, I'd have to call up Scott and ask him to do that for us. But, I think, look, from my perspective, we still do have a modest recession in the middle of the year from our U.S. economists. So I think really the question here is, does that recession call continue to get pushed out as it did through much of 2023? And if that happens, and if the Fed is willing to do quote-unquote insurance cuts, then the markets are going to be much higher by year-end. And I really think that's one of the big topics next year is, A, recession, do we get it or not? And B, kind of what is the calculus for the Fed? If you'd asked me a couple weeks ago, I would have said the Fed might be too slow to react because they want to loosen up the economy. After the December FOMC, it seems like they're not going to be too slow to react, and that might just add a little bit of juice, to your point, as we get into next year.
Well, on the Fed's reaction function, are you basically saying that the Fed put is back, or is it coming back?
I mean, that would be an initial takeaway from the December FOMC. I think my view, if you had asked me in November, would have been, they're not going to hike unless inflation hooks higher, and they're probably not going to cut unless we see meaningful weakness in the labor side of the economy. The December FOMC suggested, no, maybe there is this third option where they could actually be doing quote-unquote insurance cuts. And if they do that, I think that's extremely bullish for equities. I mean, if they're cutting in an environment, let's say, where we're printing 150K jobs, then, equities are going higher.
Well, something that we've been tussling with is how much rate cuts are actually going to matter. You think about 500 basis points of hikes, maybe causing a little bit of indigestion in the stock market at one point, not at all this year. We did have some turbulence over the summer. And then you think about the economy overall, rate cuts. Does the why we're getting rate cuts actually matter when it comes to this equity rally?
I think it does 100%. If they're cutting because they're seeing real weakness in the labor side of the economy, that's much different than if growth is sort of sideways, inflation's easing, and they decide, hey, we're too restrictive. So I think the why matters significantly, at least in my view.
At this point, though, there is a question about earnings. And I know that you say bad news is bad news and good news is good news. Have we really gotten such good news on the earnings front? I'm going to be speaking with Emily Rowland later this morning, and she basically pointed out that year-on-year S&P 500 earnings barely grew, 0.6%, and a lot of the gains that we've seen are pricing in next year gains that are expected to be robust. Doesn't that concern you?
It does a bit. I would say I think year-on-year we're tracking down about 2% for S&P. But if you had asked us last December, what is the risk to S&P earnings, people were throwing around 200 numbers or sub 200 numbers. So, the year-on-year growth isn't great, but the way the data printed relative to expectations has been, very, very, very positive. So I think that's how I view earnings this year. As we came into the year with people throwing around $185 to $200 bear market type, situations on EPS, we're now going to print something that looks more like 220. Scott at Citi is at 245 for next year, which is, going to give you pretty close to double-digit EPS growth in 2024. So, not too worried. I think if I had to describe 2023. Better than feared. And then 2024, it looks like hopefully we're going to get some actual, not only EPS growth, but a broadening out of EPS growth to a larger number of sectors, which we do think is also important.
Exactly where I was going to go. We had Margie Patel on earlier and saying maybe that story's a little overplayed. Other people still sticking with what's worked, including big tech. You're kind of taking a little bit of a different tone.
Look, we thought big tech and growth was going to work into year end, and then as you got into 2024, you needed to kind of do a little bit of a reevaluation of things. And next year, if you do get broader earnings growth after a year in which you had very narrow large cap leadership, I think there's a fair argument to say that S&P equal weight, for instance, relative to S&P cap weight would make a lot of sense. What we've seen this month is Russell 2000 has massively outperformed. So I think what folks are saying is growth may be better than we expected. The Fed actually may cut without a recession. And I've got a lot of stocks at the smaller size of the cap spectrum that have meaningfully lagged. So I think that theme has legs. I do think Russell 2000 we're probably a little less comfortable with just from a risk-reward perspective, but definitely S&P equal weight relative to cap weight is something that we think makes a lot of sense into early next year.
So we're talking about some big, longer-term themes here. Of course, what the risks look like in 2024 and the opportunities. Let's talk about 2:30 p.m. yesterday. Of course, that sudden plunge that we saw in the S&P 500. A lot of people pointing to zero-day options and the heavy put volume that we saw there. What do you make of that argument?
Our view is that the zero-date options is probably less likely to have caused that yesterday. Just talking to the clients that we talked to on a regular basis, everybody was searching. Some people said, oh, it must be the 20-year bond auction. Oh, maybe it's just low volumes, kind of late in the month. People throw zero-date options out there, I think, as a reason if they don't have another reason. It's an easy kind of fallback reason. So it's always possible that in a low-volume day, a small amount of flows can kind of get you going. And it does feel like the markets we're in now, once a direction is determined, we're just going to kind of go that way because there's not a lot of volume to push push it back. So, we're not generally in the camp of blaming zero date for these type of things. Could it be one of a few things that got listed? Some people said, delayed reaction to FedEx numbers. Some people said the 20-year bond auction. Other people said zero date options. This is just one of those, I think, late in the year, low volume, kind of we've rallied a lot. Take some risk off the table.
I like the theory that it was a delayed reaction to FedEx because that would be quite a delayed reaction.
If you don't have an answer, I think people were groping yesterday.
Yeah.
And you just they're looking for anything. What has been bad news, theoretically, that we've received in the last couple of days that could have done it? I think the most notable thing, which you mentioned earlier, is equities moved, but other assets didn't. And I think that's why people were a little bit confused by it. It clearly didn't come from the bond side of the ledger. Some folks said there were just some equity sell programs going through the system, and that might just be risk reduction into year end. Last year, we kind of had this a little bit too, though. We kind of rallied the first 2 or 3 weeks of December, and then the last 2 weeks of December last year were a little wonky. So maybe we're having that again.
So are you following Scott's advice and just buying the dip? Were you out there yesterday, just scooping stuff up, getting really excited?
I was trying to figure out what was happening. I think the buy the dip stuff makes sense. I think if you believe all the narrative we've had here, right? Well,
but this is my issue. If you always buy the dips, there will not be dips. So is that what we're expecting? All the volatility that people are talking about next year, there's a high risk of it not happening because everyone's going to buy into any kind of volatility that we see.
It's possible. There's still a lot of cash on the sidelines. If you're a retail investor who's sitting in money market and you get told rates are going lower, you just missed a 20% rally in the S&P and a 50% rally in NASDAQ. And if you believe we're not going into a recession, I think there is the potential for money to start to bleed into the market, to your point, and kind of, a retail put alongside the Fed put maybe, kind of really improves your risk reward. But to me, it all boils down to labor market data. Labor market data holds in. You just want to continue to run long equity risk. If you see weakness in that part of the economy, you need to be really, really cautious about how you manage things.
Stuart Kaiser, thank you so much for being with us. Happy holidays, Merry Christmas, Happy New Year. Stuart Kaiser of Citi. I do wonder, especially as we're watching economic data coming out 80 minutes away, we get initial jobless claims. And given the fact that it's thin markets, if you're looking for a boogeyman, an interesting print there, that could do it.
Oh, yeah, you can definitely find one in a little over an hour or so. But he makes a great point that it really hinges on the labor market right now. And weekly jobless claims, again, we get them every single week. Maybe take some of the excitement out of them. But still, as we're trying to really map out this labor market, very important.
Yes, we're trying to make something of them. And actually, a lot of people have been trying to understand them because the high frequency aspect of them. But yes, I take your point. Every week they come out, and pretty much every week they're bang on 200,000. Just now, taking a look at markets, you can see a bit of a lift. Maybe the buying of yesterday's dip after 2:30 p.m., 47.71 on the S&P. Yields basically where they've been all morning, 388.25. Crude a little bit lower. I find this really interesting. Quiescent, $74 on crude traded on the NYMEX, despite some of the concerns in the Red Sea. Meanwhile, what I'm watching right now is just some of these earnings coming in and trying to understand exactly what is going to pass as some kind of weakness, because we see CarMax coming out. We are going to, at some point, see Carnival coming out later after the bell. We're going to see Nike at a time where it's really been mixed.
It has been mixed. That's the thing. It feels like it's hard to get one consistent narrative, especially from some of these retail names. And we know that the forecasts in particular, they're always important. They've been particularly important as we stare into 2024. And if you've been missing on your earnings, if you've been missing on your guidance, you have been punished in this market. And that continues.
I'm looking right now at used vehicle sales coming in at $4.83 billion versus the estimate of $4.97 billion. The used car industry is so interesting to me. I'm hearing that there's going to be a drop in prices. We've been hearing this for a while, whether this is the disinflation, the deflation that you're talking about, how that factors in. It hasn't been playing out in numbers as much as I'd expected.
Used cars and also the housing market have been some of the most fascinating to watch this year. It feels totally broken on the housing market side, but hopefully that changes.
Why, you're looking to buy a house?
Always.
Coming up at 8 a.m., someone who can weigh in on the broken housing market, Peter Shearer of Academy Securities, as we try to get to year end with a market that is incredibly optimistic. We've brought forward some of the end year forecasts for the S&P for next year to this year, 47.71.
The Arab states seem very reluctant, as long as the Israeli-Gaza war goes on, to join in an American effort to suppress a group that is actually even more than Hezbollah launching an actual short-range ballistic missile in Israel's direction. This is going to be a huge problem because our options here are not great. In terms of deterrence, we're already past that. The Houthis don't seem to be able to be deterred right now.
That was Aaron David Miller, Carnegie Endowment of International Peace, speaking with us yesterday with a fascinating point, talking about the connection between the Red Sea and the Houthi militant attacks to the Israel-Hamas war, given the lack of involvement from Middle Eastern partners of the U.S. to try to squelch some of these attacks. Welcome back. This is really one of the key issues as we try to parse through the geopolitical risks, and this is a really important conversation. I want to get right to it. Norman Rule joining us right now, Senior Advisor at the Center for Strategic and International Studies and former senior U.S. intelligence official. I want to start there, Norman, just how much you see this as a real issue, that as long as the Israel-Hamas war goes on, we're not going to get Riyadh on board to try to squelch the Houthi militants.
Good morning. Well, I believe that's certainly true, but at the same time, Saudi Arabia is unwilling to engage in a conflict with the Houthis that could lead to further escalation against Saudi Arabia itself, with a history in which the United States and international community did not support Saudi Arabia or the United Arab Emirates with defensive weapons when they were last under attack from this organization.
So at this point, how do you see this resolving, given the fact that there's a real reluctance to have offensive strikes by the U.S. on different Yemen targets? And at the same time, the Houthi militants have pledged to continue the attacks for the foreseeable future.
In the near term, the Houthis are likely to assess what they see in terms of both the maritime coalition and how they interpret international will and fortitude. Remember that Iran retains an embassy led by a former senior military officer in Yemen, and he's providing counsel to the Houthis, likely on how to handle the West. They're likely to test Western red lines, but they're not going to seek a catastrophic response from the coalition. Remember that we now have hundreds of missiles, hundreds of air defense missiles with an extraordinary array of naval capacity around Yemen. But inevitably, the Houthis are going to seek to test our fortitude.
Well, let's talk about the Western response a little bit more. Of course, Bloomberg reported this week that the U.S. is considering military strikes against Houthi bases. Lisa mentioned the reluctance there. But when you think about what the West can do here, do you think that going on the offense is necessarily the right tactic to take?
Traditionally, the way the West has handled such attacks has been as follows. If a drone or missile is fired and shot down, no retaliation action is taken against the Houthis. If it strikes a ship and there's significant damage, or if there are deaths incurred, at that point, proportional attacks would take place. And that would mean a strike against the firing site in Yemen itself or elsewhere. There have been proposals that in order to deter these attacks, that multiple attacks would occur by the coalition against Houthis to reset deterrence. I think there's going to be a concern in Washington that would risk upping the escalatory ladder. And I don't think that's going to be the first choice.
And let's talk a little bit more directly about Iran. Of course, Iran's aggression through proxies. You write in your note that Iran continues to escape any international retaliation. In this scenario, what would that international retaliation look like?
Against Iran, very little. The West shows no inclination to risk a conflict with Iran or to risk Iranian retaliation against shipping in the Arabian Sea or elsewhere. So for Iran, in essence, it's launched its proxies throughout the region. The proxies are seeking to place Israel and the United States under siege and to touch the global economy to demonstrate their strength. Iran just needs to stand back and watch this play out.
In the meantime, Norman, we still do have the Israel-Hamas war ongoing at a time when we heard from Antony Blinken, Secretary of State, yesterday, when he said it's clear that the conflict will move and needs to move to a lower intensity phase. Can you describe what you expect to see in the weeks and months to come out of this conflict?
Well, in the near term, the Israeli forces are likely to lower the intensity of operations in North Gaza to a holding pattern. They're going to focus on Khan Yunis and the central area. This remains a very difficult challenge. And in some ways, the lower the intensity, the longer the conflict, because the longer it will take for them to eradicate Hamas leadership and military capability. But inevitably, there is going to be a pressure for Israel to drop the intensity, given the significant catastrophic human damage. It's not just just that thousands have died, but approximately 1.9 million of the 2.3 million people who live in Gaza are now displaced.
And let's talk a little bit more about how the Red Sea, what's happening there, plays into, of course, what we're seeing in Israel and Gaza. Does this threaten to widen or prolong the conflict there?
I believe the conflict has already widened. We now have a situation where the Gaza conflict, started by an Iranian proxy, has brought in all Iranian proxies to the region. It's touched the global economy. It's shifted military configurations throughout the region. Countries are spending millions of dollars on defense and shipping adjustments that they didn't spend on October 6th. This is now a regional conflict, whether or not we are willing to characterize it as such.
And of course, there are some distinct and separate conversations happening around China right now. Of course, China reportedly saying to President Biden that there are plans at some point to reunify, their words, with Taiwan. But how do you think that China is watching the developments in the Red Sea right now?
China traditionally maintains a small counter-piracy force of approximately 6 vessels. However, these vessels generally only protect Chinese-related shipping. And in fact, there's evidence that at least 3 of the vessels ignored multiple SOS calls from ships under Houthi attack. So I think China is going to maintain protective posture for its own equities in the region, but avoid being drawn into what it would see as a military engagement in the region. Russia, which has a much smaller presence, will almost certainly follow the same path.
Given your experience, Norman, as a senior intelligence officer who's worked closely with allies, do you have a sense of how much the U.S.'s relationship with some of the allies have been eroded through all of these conflicts, especially in light of some of the conflicting messages that we've heard?
Well, to be clear, we're in a situation where an Iranian proxy that fires rockets and missiles against Israel, striking civilian areas, has received a vast amount of U.S. support. An Iranian proxy in Yemen that fired a vast amount of missiles and drones against civilian areas in Saudi Arabia received only U.S. condemnation. So there is a sense in the region that we tend to pick and choose situations, and we may not be the most dependable of partners. This is an opportunity for us to reset that dynamic, but I'm not certain Washington is eager to engage in any significant regional involvement.
I just want to finish with the Israel-Hamas war and this question of, if the U.S. does not have the ears of Middle Eastern allies, what is the evolution of this? What is the end game? How does this evolve into something other than a catastrophic humanitarian mess, into something that is stable?
Well, to be clear, as I've noted, there is no such thing as a day after scenario. There is a months after scenario, because it will take months to constitute an Israeli government that is willing to deal with the Palestinians. It will take months to deal with to create a Palestinian government that's able to deal with Gaza in a situation. And we've got to come up with a security force and a humanitarian program to put into Gaza in the first few minutes of the day after. And that will take a lot of time to play out to see how that succeeds. So this is a long-term conflict, even if the violence were to end today, which obviously it will not.
Norman Rule, thank you so much for taking the time to speak with us at a time where we do have all of these multi-front geopolitical risks and these wars percolating, a couple different proxy wars, whether it's Iran or whether it's Russia. This is one of the main themes, especially heading into next year, given the fact that it's an election season, that the U.S. hasn't been able to always speak with one voice. I mean, we see that with Ukrainian funding. We see that with some of the dissent, the fact that all of the Washington lawmakers have gone home on holiday and are going to try to get something passed early next year.
Yeah, this is an extremely tricky moment for the Biden administration when you think about what's happening outside our borders. And I'll bring it back to that Quinnipiac poll we were talking about a little bit earlier. This Wednesday poll, it also found that support for sending financial aid to Israel to fund the war with Hamas is quickly deteriorating. American voters, they're concerned about domestic issues, and you're seeing that in these poll numbers.
And coming up, talking about domestic issues, we are going to be checking out the latest initial jobless claims. Yes, they are just a weekly number, but we watch them every week, and it is sort of a high-frequency view on the labor market and whether there are any cracks. The answer's been no, consistently, pretty much across the board. Will that be the same today? Coming up next, Sanal Desai of Franklin Templeton, as we try to get a sense of whether there is any bearishness left or whether the Fed really did shoot them all, as we were hearing about a couple days ago. This is Bloomberg. We're still all trying to figure out what Jay Powell was really thinking when he changed his tune. And honestly, was it him being tired, him just being real and not realizing that it would really cause the market reaction? Or maybe this is what he intended. Welcome back. This is Bloomberg Surveillance, where we parse through Fed speak a week after it, over and over again, because that's what the markets are doing right now. We are about an hour away from some key economic data. Before we get there, taking a look at markets, you can see that lift, get even liftier, 47.75, retracing some of the losses yesterday, the biggest one-day decline going back to September, with pretty much everything down except for 19 stocks. NASDAQ up even more. So that flight to the havens still very much present, up 0.7%. And the Russell 2000 up 1.1%. I mean, honestly, to me, this has been one of the stories underpinning all of this broadening out in the market action. Small caps are actually getting bid.
That's your poster child for the broadening out of this rally, because, okay, big tech, you can make the case that that's turned into a haven asset. But to see some of these small cap companies with their debt loads, with their more near-term maturities, really rallying out the wazoo here really tells you just what the sentiment has been like. And even though yesterday we did have that little hiccup at 2:30, we are still on record watch for the S&P 500. It could come by 2024. That's right at about 4,800. We're about a whisker away.
We'll just keep that wazooing right up and see if we get there. We're also seeing in the bond market that bid pretty persistent. Today a little bit off of it, but yesterday, even with some of the sell-off in the stock space, we did not see it in the bond space. And you could see that any kind of sell-off is actually getting paired back with more of a bid into the bond market. 10-year yields now at 3.8695%, if you really want very specific numbers. 2-year yields 4.36%. Really, it's you've mentioned this, Katie, the fact that we still see a very severe curve inversion. And when does that start to shift? That people start to expect the Fed to cut rates sufficiently to generate growth over the longer term. We're not there yet, because if we're calling the all clear, this implies maybe a more inflationary picture than the Fed would like.
Yeah, and we'll see how that plays out along the curve. It does feel like the center of gravity really along the entire curve right now is about 4%. Of course, your big outlier is that 2-year yield. But whether we get that bull steepening as rate cuts start, over in the summer, it looked like it was just the 10-year going up that was going to drive us back to positive. Obviously, the opposite dynamic at play right now.
We're under surveillance this morning. Let's get right to it as we try to understand the landscape heading into 2024. A mega deal between two media giants could be in the works. Warner Brothers Discovery holding talks in a possible merger with Paramount in a move that would unite CBS and HBO under the same roof. The deal still in a preliminary stage with no formal talks underway, just simply a lunch between CEOs. That's what we heard from Axios, with them both meeting in New York on Tuesday. Right now, unchanged on Paramount. Warner Brothers up at 1.2%. Is basically a mating of desperate companies. That's sort of what we heard earlier this morning.
Yeah, and it seems like media consolidation, that's been the rallying cry. That's been what people have been saying is going to happen. Maybe we are truly seeing it happen. And you think about how M&A overall has been pretty muted, but we've seen it in a big way in the energy sector this year, despite muted volume overall. Maybe we're going to see it in the media landscape. Whether it's these two actual companies tying together remains to be seen, but maybe a foretelling of what's to come.
And this has been something everyone's been talking about for kind of a while. So we'll see if they can actually pull the trigger. This story really caught my eye. Citigroup said to be exiting the distressed debt trading business in its pursuit of higher returns. The news coming on the heels of another announcement that it's getting out of the municipal bond trading and underwriting. Meanwhile, and this is sort of the other side of the same coin, Morgan Stanley discussing a potential move into a new private credit fund that would include capital from external investors. The bank holding preliminary talks about injecting $1 to $2 billion of capital into the new vehicle. The reason why I say two sides of the same coin, how much is it? Either you're all in or you're all out. You're either in, the capital intensive distressed debt trading and investing, or you can't be, because on a regulatory standpoint, it just isn't economic.
Well, it's clear where Citi falls, and I think it's so interesting watching Jane Fraser at work here. Of course, she announced in September, I believe, that she's going to be undertaking this big restructuring, and that has really picked up as we head towards 2024. The muni bond news last week, now distressed debt trading. And it's not like they were bit players in either of these markets. So it's big for Citigroup, but it's also big for these asset classes.
And Jane Fraser is definitely taking some bold moves and moving quickly. Meanwhile, the U.S. considering raising tariffs on Chinese electric cars. This according to the Wall Street Journal. The report saying the White House and other agencies are set to wrap up a long-running review of whether to uphold Trump-era tariffs on roughly $300 billion of Chinese goods by the early next year. The move would serve to insulate the U.S. green industry. So two things. One, this could potentially make it more economic for electric vehicle manufacturers in the United States. But two, it makes Biden look tough on China heading into the election.
And that is a popular thing to do. That is one of the few bipartisan issues left out there. But because we talk about Tesla all the time, and maybe this is revealing something about myself, you kind of forget how dominant China is when it comes to the global EV market. What a powerhouse it is there. You look at some of the numbers expected for next year. They're expected to account, China, for 60% of the world's new passenger EV sales in 2023, rather. So, of course, this has big implications for the EV market potentially, but it's already kind of hard to sell Chinese EVs here.
Which is by design, and Germany is looking at doing the same, especially after their car manufacturers took a look at Chinese additions and said, they're really ahead of us. Let's get straight to markets right now, understanding just how much everyone's thrown in the towel and gone all bull after the Fed meeting. Sonal Desai joining us now, fixed income CIO at Franklin Templeton, who's been a sobering voice for us throughout the year, saying, wait, let's just fully understand where everybody's minds really are at. Are you throwing it in terms of going full bull in response to the Fed?
No, I really am not. Here's the thing. A month ago, Powell told us that he might not need to raise as much because the market was tightening for him. I think the market needs to recognize that we're easing for him right now, massively. We have eased a lot. The economy is going to respond to that easing. And yes, the Fed is likely to cut next year, but every time the Fed announces cuts, the market doubles those cuts. Right now, we're anticipating pricing 150 basis points of rate cuts next year. I'm not sure that the data warrants that yet. I am a little puzzled that Powell took the decision of doing what I would consider, for a central banker, he threw caution to the winds. He essentially he announced mission accomplished for all practical purposes. So, yeah, I'm not throwing it in yet. I'm not going all in because I think the speed of the move has much more a sense of markets trying to predict the Fed's reaction function rather than markets trying to predict what's happening in the real economy.
And Sonal, you and I spoke last week after the Fed meeting, and I asked you about that reversal that it feels like we got from Powell from early December to last week. And you said that you were baffled, and I really liked that comment because it was so candid. Has the Fed speak that we've heard in the days since helped clear anything up, or what is the communication message of the central bank right now?
So right now, I think what really isn't clear is what the Fed's trying to do. I mean, I don't think did Powell really, after these last 3 years or the last 15 years, not know what the market's reaction was going to be? And I'm not sure the Fed, the subsequent Fed speakers, they hadn't had the impact which perhaps they wanted to have. But at this stage, I still am not sure what impact they wanted. They clearly wanted a rally. Are they trying to fine-tune the extent of the rally that they wanted? Because this is now getting deep into markets and way outside what I think central bankers need to be doing.
Well, to that point, you think about the gulf between what the Fed is signaling and what the market is pricing in. The Fed penciling in 75 basis points of rate cuts next year. To me, that looks like normalization. You think about the market pricing in 6 rate cuts. That sounds like a recession to me. Where do you fall?
No, I think I'm going to actually go right now on what the Fed's telling us, which is about 75 basis points. I think 50 to 75, I can see that. You know, there's enough uncertainty on the pace at which disinflation occurs to make that reasonable. For 150, starting as quickly as the market anticipates, you need to have serious recessionary signals, at which point I'd really question these massive rallies that we've seen in risk assets, be it the stock market or be it risky assets, credit spreads, and so on in fixed income markets. There is some cognitive dissonance that we're seeing between the two sets of markets here. This feels a lot more the Fed's going to cut rates because inflation's going to come down, the economy is not going to slow, and they're just going to cut rates. And that seems to be a bit of a stretch.
Just quickly here, Sanal, what are you doing with this? How much conviction do you have to lean against some of the euphoria that we've seen?
So I think that if we see after tomorrow's PCE number another massive rally, I think I will have greater conviction to lean more decisively against it. We're certainly not chasing this rally.
Sanal Desai of Franklin Templeton, thank you so much for being with us and for your real speak. We always appreciate it. Have a wonderful new year and a holiday. Right now, we are getting some breaking news that Angola is exiting from OPEC. This according to the Jornal de Angola, and it comes after some consternation at OPEC Plus about whether it was going to cooperate with some of the production cuts that were put out for it. You are seeing a response right now in crude, Katie.
And you remember, of course, the latest meeting delayed, actually. Interesting to see crude reacting to this. Crude oil currently down about 1%. And if you take a look at the intraday chart, of course, spiking on the heels of this news, it'll be interesting to get more reporting on this, maybe some reasons why. We can draw our own conclusions. But, of course, this is a developing story. And also, when was the last time a member country actually exited from OPEC? These are all questions I would like answers to.
I don't have an answer to that. It is a good question. This does, though, show me some of the division on OPEC Plus about cutting production, because these are some of the members in Africa in particular that are members of OPEC Plus that were concerned about cutting as much as Riyadh was hoping that they could to get prices up. If they keep producing more, this becomes even more of a supply issue, which we've already seen with the U.S. and could potentially flood a market at a time where people are worried about demand. But really, this has been a supply story ultimately.
Oh, big time. I mean, you talk about the non-reaction, it feels like, in oil to all the different geopolitical tensions in the world right now. And like Lisa said, it's really been a supply story. And it's a really tricky moment for OPEC. You bring up U.S. shale production just absolutely growing and growing. What that means working against those OPEC supply cuts. And all of this is playing out in crude right now, currently hovering around $74 a barrel.
And the U.S., meanwhile, is pumping record amounts of oil, more than, I believe, a lot of the OPEC members combined. If you take a look at what we have been doing in the United States, taking a look at gasoline prices, and this to me is sort of an interesting litmus test, especially given some of the consumer confidence that came out yesterday. Prices are at $3.12 right now on average across the country, and that's from a high close to $4 earlier, just a couple months ago. So it gives you a sense of just how much we've retraced some of those higher gas prices. If you are just joining the program, we can see a lift to the market up about 0.5% on the S&P 4774 following the worst one-day sell-off going back to September. Bonds did not participate on the way down, with yields lower yesterday. We could see them marginally up today. 10-year yields 3.87%. Two-year yields also just marginally higher, but still well off recent highs, which I find interesting given still a lot of the pushback to potential rate cuts. Going forward, though, this is going to be a question, right? Whether it is sustainable to get the level of rate cuts that people are pricing in if we don't get some kind of recession. And this was sort of the philosophical difference that I hear from Sanal Desai and other people who are saying, actually, the Fed is just saying that in response to disinflation, even without weakness, we can essentially cut rates. It's sort of the battle of transitory all over again.
And this Fed is one that's been a little bit communication challenged. I don't want to be rude, but just communicating what actually is motivating these rate cuts and the magnitude that we're going to get. I mean, in conversation with Sanal Desai, the point that 6 rate cuts, that looks like a recession. That looks like a little bit more than just normalization. Of course, we're trying to get back to neutral. 6 rate cuts in 1 year would be quite something to behold.
Communication challenged?
You know, to put it mildly.
Well, I think it was very confusing when Jay Powell said, yeah, we were talking about rate cuts, and then John Williams said we weren't really talking about rate cuts, and then what's really mean?
In a room.
I mean, it sort of raises this question of, what message are you trying to send? We're a little bit all in a tussle. Coming up at 8:30 a.m., not in a tussle, Steve Rasciuto of Mizuho speaking to us after we get the initial jobless claims. Do we see that weakness that some people are saying might be required to get inflation to the point that markets are currently expecting?
The word from pretty much all the Wall Street banks is they expect a better 2024, even though investment banking activity is about half the average level for the last decade. But, we were in this spot a year ago saying, okay, deal's going to pick up, and it didn't. And it feels like we keep waiting and waiting and waiting.
Maybe it can't get much worse. That sort of seems to be the feeling on the street. Mike Mayo there of Wells Fargo weighing in on what has been the worst year in deal making in decades. Mergers and acquisitions down roughly 25% in 2023 from a year ago. The slump leaving bankers confronting a bleak bonus season and more job cuts if business doesn't pick up in the new year. It is likely to, though, and that seems to be what we're seeing right now with some of the deals being proposed and floated as we get headlines on the terminal. Joining us right now, I'm so pleased to say, Frank Aquila, a senior M&A partner at Sullivan and Cromwell here on set. So what makes you optimistic, Frank, that we are going to get some sort of resurgence? And I know you can't speak directly to the Paramount and Warner Brothers deal, but some kind of resurgence in M&A at a time where people can't borrow as easily on overly indebted structures.
Well, they can borrow. The issue is at what cost? And to the extent that interest rates were going up and you didn't know where the top was, a lot of boards and CEOs were not prepared to make the leap. But now that you say, okay, this is the top, it's likely to go down, maybe 3 cuts next year. I think you're going to see a lot of companies, many of which have plenty of cash on their balance sheet. So, they're not borrowing all that much. They're going to go back into the market.
Which areas do you think are going to be most active? Is it going to be the year where finally we see the tie-ups in the media space really the dominant story, or is it going to be across the board?
I think it's going to be more across the board in terms of both geographies. I think it's going to be more widespread, not just the U.S. I think it's also going to be a lot of sectors. The sectors I would look at is obviously media consolidation, but the energy and natural materials sector, and healthcare. Even in the worst of times, you see big healthcare transactions happening, and with so many pharmaceuticals coming off of patent and going generic, the big pharmaceutical companies have to constantly refill their pipeline. Their R&D pipeline is limited, so they have to go out and acquire these smaller companies. And that's what you just saw with Pfizer acquiring Seagen.
Mm-hmm. And of course, a lot to keep an eye on there from an industry perspective. But you mentioned, though, that it's not going to be just the U.S. So let's talk about global deal-making volume. Of course, as Lisa said, you take a look across the globe, falling under the $3 trillion mark for the first time since 2013. And the reason we keep hearing is that there was just a lot of uncertainty in the world in 2023. But then you take a look at 2021, when there was also quite a lot of uncertainty, and global deal volume came in at $5.3 trillion. What's the difference between the uncertainty that we saw in 2021 and 2023? Is it just interest rates?
It's really three factors in my view. One is the interest rates. And again, not knowing how high interest rates were going to go. Second was the fact that there's so much regulatory scrutiny. And the thing we're seeing is that deals are getting done. It's just taking a lot longer. So CEOs and boards want to factor that in. The third thing is global conflicts. I mean, the two biggest, obviously, Ukraine and Gaza. But there are other conflicts around the world, all of which I think depress the need and the interest in doing further consolidation. But to some extent, those are factored in now, and with interest rates at least stable and probably going down, I think we're going to see more deals in a number of sectors and a number of geographies.
And of course, you have a unique perspective on this next question, actually being in some of these rooms. But given the antitrust environment that we've seen under the FTC, how it feels like the FTC has been winning, but it's also been losing some of its antitrust cases, how are potential merger combinations? How's that conversation evolved? Is it more likely that maybe you'll just go for it, take your chances, versus we're only going to do this if we're sure we can get this through?
Right. I think 18 months ago, a lot of CEOs and boards were saying, we don't want to do this unless we know we can do it and we can do it quickly. Now, as people have gone through this and have seen that, whether it's Pfizer Seagen or Microsoft Activision, that it's going to take longer, they just factor that in. And so they'll go forward knowing that they might have to litigate, but with a sense that in most cases they're going to prevail. Not in every case, but in most cases they've prevailed. And while the FTC would like to change the antitrust laws haven't changed, and the federal courts have been pretty good at pushing back on them.
Is there a new sense of urgency right now to merge, just given the fact that what we've seen over the past couple of years is that bigger businesses have done better? That economies of scale have allowed them to survive and be more resilient, and they've gotten bigger and, frankly, been rewarded much more in the stock market?
I think that's the case, and you're hitting on a very good point. With new technologies, AI, generative AI, that's going to take a lot of investment for companies. And small competitors are going to have a hard time doing that level of investment. In the 90s and the early 2000s, we saw a lot of bank consolidations because they needed to put in a lot of new technology and infrastructure, and it was only the bigger banks that really could afford that. So I think we're going to see a lot of industries looking to invest in technology, and that's going to be expensive.
I can't help it. I have to ask you this question because I do have lawyers in my family and who are close friends. But there is this big debate about whether ChatGPT is going to take away some of the very long hours of associates that have to go through all of the documents on deals, and whether that could potentially make it a more livable experience, and the bigger law firms will be able to do that in a more significant way. And if that's sort of the path forward for a lot of the legal professions, do you see that actually happening?
Well, we've seen that to a certain extent in litigation, and I'm not a litigator, but in terms of document review and whatever, technology makes it easier. And, the reality is clients don't pay us significant fees because of drudge work. They want the creativity, they want the expertise, and the more you can devote your attention to dealing with issues, dealing with problems, advising them, the better it's going to be. And it's a better existence, as you say, for particularly the younger lawyers that don't have to spend 16 hours a day with, not very interesting work.
Just to totally shift gears here, have you heard of hipster antitrust?
Yes.
I'm a little obsessed with it at the moment. Do you think that that's actually a new way of thinking, a new approach that will stick?
It might be. I'm not convinced yet. I'll put it that way.
All right.
I do like that, this idea that there's some sort of philosophy. Just real quick, though, I do want to get your sense, before we let you go, of what you think, what industry you think will have the biggest deals this year, given the fact that it does seem like we have to get more activity than we got this past year.
I think number one is going to be energy. I think that's where we're going to see the consolidation. Oil prices are down because the long-term outlook isn't that good. So the big companies need to consolidate.
And we've already seen that to some degree. Thank you so much for being with us.
Good to see you.
Frank Aquila of Sullivan and Cromwell with us on studio. And we did get a number of deals, including another deal that we didn't mention, just crossing, that Blue Origin and Cerberus are bidding to buy the United Launch Alliance. This is basically the conglomerate of different billionaire space opportunities, I believe. So opportunities maybe in the space consolidation space.
I don't know how much more opportunity for consolidation there is there, but interesting to see that it felt like very much like bull market behavior when we had all these billionaires launching their rockets into like suborbital space. I missed that time.
In fairness, some of the SpaceX exploration and the satellites, Starlink has been a raging success and has led to a lot of dominance when it comes to the satellite system, and we're talking about the potential IPO of that coming up as well. I'm sure a lot of bankers are looking forward to a more active year after what the weakest volume of M&A going back to 2013. Coming up next, we are going to be speaking with Peter Scheer of Academy Securities to understand what happened yesterday after 2:30 p.m., but also the road ahead in a year that is going to be pocked with uncertainty, pocked with political disruption, and pocked with geopolitical risk. Right now in markets, you are not seeing that geopolitical risk or political pressure or other uncertainty anywhere in sight, up about 0.5%. 47.74 crude, lower after that news on Angola. This is Bloomberg.
with the Fed taking its foot off the brake, there's the risk that inflation reemerges at some point.
When I think about the next year or two, I don't really see any meaningful catalysts to sort of break us out of what could be a really sluggish growth backdrop.
We may ultimately get a mild slowdown or a mild recession, which would be characterized as a soft landing. But I think it's a really dangerous landing at this point.
We don't need the consumer to be in a recession for the U.S. economy to be in a recession.
Those savings have been whittled away. We do think we ultimately end up having a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here come initial jobless claims as everyone starts to wonder, okay, is the labor market really all that strong? From New York City for our audience worldwide, good morning. Welcome back. This is Bloomberg Surveillance live on Bloomberg TV and Radio. Tom and John are both off on a well-deserved break into the new year. I am so lucky to be alongside Katie Greifeld this morning. As we get you through the day, we are about 30 minutes away from initial jobless claims. That, to me, is key at a point where so many people are hinging their bets on a soft landing.
Oh, big time. Again, when consensus is so one-sided, when the market is so one-sided, maybe we got a 1% move lower yesterday. It feels like every single data point takes on more importance. And especially when you think about how thin liquidity is right now, could definitely leave a dent in some of these charts.
Which is the reason why people are so focused on what happened yesterday at 2:30 p.m. when all of a sudden stocks fell off a cliff to have their worst daily loss going back to September at a time where there wasn't a clear catalyst. Yes, you heard Patrick Harker talk about the need to cut rates in light of some possible headwinds that he sees coming down the pike. But is it that? Is it a delayed reaction to FedEx, which is what we were hearing from, was that Stuart Kaiser?
Yes, it was.
So at what point are we seeing some kind of disruptions under the surface that give some people agita?
And I will say it's interesting to see how broad-based it was. Of course, you've been bringing up that point that it was broad-based on the way up, broad-based on the way down. But overall, it feels like the fact that you have seen this rally broaden out over the past 2 months. It's not just those top 7 names dragging the index higher. That's been a rallying cry of the bulls, saying that this one has momentum.
Which is the reason why I'm so focused on some of the earnings that we've been getting. Yesterday, we heard from FedEx. They gave a weaker than expected forecast on volumes. People aren't sending as much. And they aren't able to charge as much on the express offering. You also heard from General Mills. I guess Lucky Charm sales are down. So there's a question around the appetite of people there. Today we get Nike. How much are the corporate earnings going to express the same kind of euphoria that we've been seeing in the stock action?
I will say everything about this economic cycle, about this market cycle has been strange. And I was checking out some of the sector performance year to date yesterday. Consumer staples are lower on the year. You think about how much of the conversation has been dominated by inflation, by these conscious consumers, resilient, but really conscious of how high prices are right now. And yet consumer staples, you would think it would be a winner, not this year.
Prices, meanwhile, are rising this morning across the board for equities. We can see the S&P up about 0.5% right now as we head toward the open, 47.73 on the S&P. You can see yields just marginally up, but definitely the bid coming into the bond market as time goes on. 3.86% now on the 10-year, solidly below 390. Thinking about some of the peaks that we saw in late October of nearly 5% on a closing basis. Just shocking to see more than a percentage point of a decline on that 10-year yield. In crude, I want to just note this, that we did see that sell-off accelerate after news that Angola was planning to exit from OPEC amid that spat over oil quotas, this according to the local newspaper there. But we have more reporting on this, and we are seeing a response in markets as people anticipate more supply coming to the fore. We were talking earlier this week that the Fed shot all the bears, not all of them. One of them still remains, or a number of them maybe, and Peter Scheer, head of macro strategy at Academy Securities, who hasn't been bearish, but maybe is starting to get a little bit more so. You recently are starting to feel a little bit more negative. Why?
Post-Fed, I thought, okay, this can run a little bit longer. I haven't liked how the market's traded very much. You've continued to have this rally in the Russell 2000, the small caps, CRE, small banks. It's been a phenomenal rally. Russell 2000's up 18% since November 7th, and yet everyone still wants to talk about Magnificent Seven. And NASDAQ 100 has not done much since early December. I think it's up 2%. And the way things have traded, I don't like. I think yesterday was a precursor that instead of buying the dip, I think you're supposed to sell into this. I think we're going to feel a little bit pressure on the big caps coming into the new year.
And do you think that this is going to come from people who are worried about recession? Do you think this is going to be technical? Do you think that there's just some sort of pressured selling that is overwhelming any of the narratives that people are trying to come up with on the back end of them?
I think, as you said, all the bears got shot, so that money got forced in the market. People are already long anticipating, the year-end flows you're going to get, the early year flows you get as RIA start funding. And I think that's just overdone, and people got too excited. And the one big problem with these large caps is if there is selling pressure, the market caps are so large, it's very difficult to absorb them. And one thing that really triggered me is probably overnight, I kept reading how yesterday everyone wants to blame zero-date expiration options for why we sold off from 2 to 4. If you go back 3 of the last 4 days, from 2 to 4, we had these weird spikes, which were probably largely due to zero-date expiration options. So when people highlight something as a culprit, it tells me everyone's kind of long and is looking for an excuse of why they were wrong yesterday. And that's why I think there's more staying power to selling pressure right now.
Well, Peter, just to draw a line under the point you're making, are zero-day options just a convenient excuse at this point, or is this something that maybe we should be worried about?
I think there's something that's there every single day. I think, as always, when people are bullish, they're going to ignore why things might have happened. So I think they ignored the pressure that zero-day expiration options put. And the one thing that I talked to a lot of clients about is, for a while we had this weekly option trade, right? People would come in on Monday mornings, buy Qs, they'd buy individual stocks on the option side, then they'd pressure it all week and it would rally into Friday. The APE stocks benefited from that. But that was really a long-only type trade. It was difficult to do that from a put side. I think on the zero-date expiration options, it's just as easy to push things lower as higher, and that's what people forgot, and I think that's what we're looking at right now. It happened a lot prior year. It's starting to happen again.
I haven't heard ape stocks in a while. That's a nice blast from the past. Let's talk about the spiritual opposite of some of those meme stocks. Let's talk about the bond market and what is going on at the long end of the curve, because I understand what's happening at the front end with 2-year yields. I mean, really just a proxy for monetary policy expectations. But like Lisa mentioned, you think about 10-year yields a percentage point lower than where they were in October. What is being priced into the long end of the Treasury curve right now?
I think fear of missing out almost. First you had the squeeze, people are short. But I think right now people are like, well, I can buy my 5% 2-year or whatever it is and make some money. But what happens if yields go all the way back down? Is this my one and only chance to own the 10-year at 4%? And you've seen that in the muni sector. I like closed-end funds in the munis as a really good indicator of retail appetite. And you're seeing discount to NAVs really shrink. So I think people are saying, wow, what if we go back to sub 3% on the 10s? I better buy some yield right now. So it's been a duration grab. I think it's misplaced. That's what's going on. And so again, it's something I want to start fighting. I think we should be back above 4% on 10s. It's going to take a little bit of a while, but you really see, I think it's FOMO. Like, what happens if we are back to 3%? Will I smack my head and say, I missed that one chance to own at 4%, assuming you already missed the chance to own at 5%?
So you're leaning against this. Why? Is this basically a fear of reigniting inflation on the heels of more accommodative financial conditions? Or is this because of supply chain disruptions and other potentially inflationary catalysts?
Yeah, I think the inflation argument is still somewhat there. Again, I fought against inflation. I was on the deflation camp all last year. Now people seem to have gotten a little bit too comfortable that inflation's gone. I'm worried about what's going on with the supply chains. The Panama Canal is an issue. Now you've got the Middle East and the Suez Canal is potentially an issue. So I think you're going to see some upward pressure on that. And then I really fought back on the argument about 2 months ago about Treasury supply and the cost to the government of higher yields. And I said, that's not a today type event. Those things take a long time to play out. And that's one reason I got very comfortable being bullish at 5%. But these things are happening. And just because we went from 5% to 4%, it doesn't change the trajectory of how big of a part of their deficit debt spending is going to be, maintaining interest payments. So those are real issues. I think people will get back to focusing on that. DC will probably somehow do a good job reminding us of those issues, and that'll push us back to that 410, 420 level.
Such optimism that they'll be able to remind us comfortably of all of those issues. Once again, Pete, I am curious. You say you are leaning against both the bond and the stock rally. How much so? Is this going to be sort of a top blow off that people are expecting to start the year that then will be a buyable dip, or is it something deeper?
I think it's more that. It's going to be, you want to be cautious here, maybe take advantage. I don't see much more than a 5% drop because I do think the Fed put is fairly back. And I am looking for things to own. I actually really want to own energy stocks. I think They've been one of the underperformers. I don't love oil itself, but I think energy stocks are playing. It was really encouraging when your last guest picked that as being his probably top candidate for M&A activity. So I think that's where I want to be leaning heavily. I've liked the laggards for a while. I'm less enthusiastic right now about the banking side of things. I'm less enthusiastic about Russell 2000 as a whole. I do like the energy, and I still like commercial real estate, to be honest.
Wow. Okay. So some really brave, interesting predictions there. I will say when it comes to energy, really interesting sector. It's down 4% this year, of course, following 2 years of double-digit gains. But just to meditate a little bit longer on what's going on in the bond space, you mentioned that this grab for duration is a little bit misplaced. Are you more comfortable with credit risk or duration risk at this juncture?
I'm very comfortable with credit risk. I think at the investment grade side of things, there's an ongoing thesis that I have is that people are going to overweight investment grade credit versus treasuries. I think you're getting much better signals from a lot of these U.S. companies. They did such a good job of issuing long dated debt. And then at the other end of the spectrum, I think people have been so bearish on the triple C, single B minus sector, especially in the leveraged loan, that there's money that's going to start coming into the market. I think there's a lot of money got issued or allocated to distressed investors. Those distressed opportunities aren't coming up. So if they have to chase that market, I think you kind of get this really nice squeeze on credit. You get the bottom end going better. You get the high quality doing well. If you see the CLO market return more robustly, which I think there's signs that that's going to happen, that will help credit. So I actually like credit risk better than duration risk.
Peter Scheer, thank you so much for being with us. Have a wonderful New Year. Merry Christmas. Happy holidays. Peter Scheer there of Academy Securities. If you are just joining the program, we do see a lift across the board as people retrace from yesterday's loss. We saw the worst loss going back to September, and it was broad-based. Today, we're seeing broad-based gains, 47.74. The S&P up 0.5%. I do want to just follow up on the story about Angola leaving OPEC. You asked the question, Katie, was this the first OPEC country in a long time to leave? Ellen Walt, a friend of this program, puts out on Twitter, not a huge surprise given how it's been going for Angola. Remember, Indonesia left OPEC in 2017, right after the formation of OPEC Plus, and Qatar left a year or so after that. So it's not unprecedented in terms of just the absolute exit. You are seeing crude continuing the decline, down 1.7% on the NYMEX, Brent down 1.6%, $78.44. Reportedly, Angola is leaving OPEC following 16 years of membership over a dispute over production quotas, so having to do with needing to or wanting to produce more.
And it's interesting, with Angola finally leaving here or announcing that they're going to leave, now membership in OPEC will shrink to about 12 nations. And like you said, this has been a really tense time for OPEC, trying to figure out where they want production to be, what they want it to look like. Of course, as crude seems to only respond to supply right now, and we know that demand hasn't exactly been there, maybe in the way that it was expected coming into 2023.
And demand from where?
Yeah.
Right? Is it demand from China because the U.S. is supplying itself with so much oil that it doesn't even need any of the oil from overseas, right? So then the bulk of the imports from the OPEC Plus nation will be from China. We're going to keep an eye on this, especially given that oil has been one of the biggest surprises this year. Coming up at 8:30 a.m., we've got Steve Rasciuto of Mizuho Securities reacting to jobless claims. This just in from Andrew Hollenhorst over at Citi, talking about Patrick Harker's dovish pushback. Harker's comments, he wrote, help confirm that Fed officials are anxious to cut as they're increasingly worried the economy will enter recession. From New York, this is Bloomberg.
I think the notion that Xi Jinping is determined to pursue reunification with Taiwan is not new. Beijing continues to exercise what you could call strategic patience on this issue. And that's important because if that changes, it does, I think, increase the near-term risks around Taiwan. For now, I think those near-term risks are manageable.
That was Michael Herson of 22V Research reacting to an NBC report. The Chinese President Xi Jinping told President Biden that China plans to reunify with Taiwan. Senator Lindsey Graham having some fiery words about that, commenting on the report, saying he would, quote, draft pre-invasion sanctions from hell to impose on China if they take action to seize Taiwan. We are hearing about potential sanctions on Chinese electric vehicles from this administration this morning. Joining us now, I'm so pleased to say, is Susan Thornton, Senior Fellow at the Paul Tsai China Center at Yale. Susan, I just want to get your sense of how much of a sort of increase in a threat the NBC report on what Xi Jinping told President Biden really was.
Yeah, thanks very much. I think this is really a tempest in a teapot. The things that Xi Jinping said on Taiwan in the meeting with Biden are absolutely not new. The Chinese have repeated at almost every occasion that Taiwan will be reunified at some point. So I don't think anything that the Chinese would have said on this issue would be considered new by people who watch this issue. Maybe by people who don't watch this issue, they would have been surprised. But I do think the Chinese are kind of reflecting some concern that U.S. policy is shifting toward a support for a kind of permanent separation with Taiwan, and that would be maybe something that would be causing them a little bit of alarm and may have added some oomph to this kind of statement about Taiwan will be reunified.
They added a lot of oomph this morning when you talk about the potential prohibition of exports of certain rare earth metals that are really crucial in a lot of electric vehicles. And this comes as there are reports that the administration in the United States is thinking about possibly increasing the tariffs on imports of certain goods having to do with electric vehicles from China. Is this a really material increase in the tit for tat, the trade war that we saw really heat up a couple of years ago with China and the U.S.?
Well, the Chinese have already announced in a couple of other occasions some selected restrictions on exports of rare earths, trying to show that they have cards that they can play too in this tit for tat trade war. I think what we're seeing from the Biden administration is a desire to kind of adjust some of the tariffs that the Trump administration had imposed on China and which the Biden administration left on. So, EVs are a particular concern because of the desire to try to ramp up manufacturing here in the U.S. Of course, they're also a big concern in Europe. And so I think that's what we're looking at. Certainly, this is a hugely successful sector for China, so they don't want to see this tariff imposition happen. I think probably they're resigned to it at this point, and this is probably just a lot more signaling than something that's unexpected.
So resigned to tariffs, but what about when it comes to sanctions? I mean, to go back to what Senator Lindsey Graham said, saying that he is intent on drafting pre-invasion sanctions from hell to impose on China if they take action to seize Taiwan. How would those sanctions be received, and would that actually deter China in any fashion?
Yeah, I think it's really important that we sort of try to separate the Taiwan issues from the trade war issues because they are very different, and people have, a tendency to try to lump all these things together, especially up on Capitol Hill. The issues around trying to draft, pre-invasion sanctions have been talked about up on Capitol Hill for a while. It didn't work with Russia, and those sanctions were probably much more dramatic than anything that could be imposed on China in terms of trying to get the rest of the countries in the world to go along with it. Of course, the sanctions regime only works to the extent that you can get other countries to also join in. So I think this is an effort by, people to try to show the Chinese that we really don't want them to do this. But again, the summit was very successful, the summit in San Francisco between President Biden and President Xi in trying to tamp down this issue. And it seems now like there's a desire in some quarters to try to ramp it up again. And I think that's unfortunate. I mean, we really do need to see some stability on this issue going into what's going to be a pretty tumultuous year in U.S.-China relations, I think.
Well, Susan, to that point, of course, the APEC summit, it was perceived as going well. And I think that's why part of the reason why there was surprise to see this report from NBC yesterday when it comes to China's intentions with Taiwan. But I mean, you made the great point that this isn't necessarily new rhetoric from China when it comes to Taiwan.
Absolutely. I think the summit actually on Taiwan, my understanding is the two leaders didn't really spend a lot of time on that issue, and that there was a tacit agreement to try to work to manage this difficult issue. We have the Taiwan election coming up on January 13th. That's going to pose, tensions and some difficulties in the relationship. There'll be an inauguration in May, and there's always a lot of back and forth between the U.S. and China on how these issues will be handled. And I think what we were trying to get from the summit was that these issues will be handled, carefully. And that was the message that was trying to be conveyed. And now we've sort of got back to this increased sort of hype around a possible military action, which I agree with Michael Hurst, and I don't think is imminent.
Given the fact that we are dealing with a very political year heading into the election at the end of the year, how can there be any kind of diplomatic discussions between China and the U.S. with any conviction if it is not clear who is going to be in the White House come 2025?
Well, this is an issue for diplomats working on relationships with pretty much every country in the world right now. I mean, all countries are kind of looking at our political situation and wondering what's going to happen and wondering what kind of commitments they can make with us in the coming year. So it is difficult and probably especially difficult with China. The only thing I would say about the U.S.-China relationship is that it's less likely probably to turn on a dime with the accession of a Republican president, be it Trump or anybody else, because I think there is this kind of bipartisan approach to China, which is quite, hawkish at the moment and probably won't change no matter who comes into the White House. And I think the Chinese do know that. So they are looking at, the coming year and then the years after at sort of how to manage what's going to be a pretty difficult time, I think.
Well, Susan, you bring up a question that I think about all the time when it comes to U.S.-China relations. A lot of these issues go back years and years. They outlast any one administration. And like you mentioned, being hawkish on China is very bipartisan at the moment. And with that in mind, how much does it truly matter? How consequential is it who is actually in the Oval Office?
Well, you mentioned that being hawkish on China is bipartisan now. I mean, I think it actually goes a long way back, and almost every issue we have today with China has been around for decades, especially on Taiwan. If you go back and I've been looking at historical records lately from the Carter administration, and every single issue was talked about at the time of normalization between the U.S. and China in 1979. So we're 45 years on from that, and I think it's just going to be two big countries, huge economies, important players in the world, and it's just going to be so difficult to figure out how to manage all of these issues. I think the most important thing is that whoever's in the White House should be expressing confidence about the future of the United States and our ability to be resilient and, maintain our competitive edge. I think that's the most important thing.
Susan Thornton of the Paul Tsai China Center at Yale University, thank you so much for being with us. We have been hearing a lot of the tit for tat, and one person after another says this is just basically showcasing the already there tensions that have been in place for a long time.
And I can't decide if it's comforting. I mean, to go back to that question of how much does it matter who is in the Oval Office? I mean, a lot of these issues, they outlast any one president. You think about how bipartisan it is, the approach to China. It's going to be a very interesting presidential election cycle. But again, a lot of this is outlasting them.
We are about 4 minutes now away from a key initial jobless claims, the resilience of the U.S. economy for front end focus. As we take a look at whether the labor market continues to hang in there, certainly equities do. We could see the lift maintaining up 48 basis points, 47.72, yields just marginally higher. You could see oil declining on the prices of Angola. Just seconds away from the key economic data of the day. We get initial jobless claims in just a moment, setting up the market action. You can see a lift ahead of that as people retrace, rethink. Maybe this is a buy the dip moment. Yesterday was a dip. you buy it. 47.72, up about 0.5%. Yields just marginally higher, 3.85%. What I'm looking for here is a sense of initial jobless claims coming in with the expectation of 215,000. They do come in. They are below expectations. Once again, 205,000 jobless claims. That is up marginally from the month before, which was 202,000. That is the unrevised number. We have not yet gotten the revision. We also get a slew of data. This is the third revision of third quarter GDP, and so that came in actually a little bit lower than expected. The survey called for 5.2% in terms of third quarter growth. The actual is 4.9%. Across the board, though, not much change on some of the individual components. You're not seeing a tremendous reaction in markets, although S&P futures continue their lift, and you can see that pretty much across the board. NASDAQ futures up about 0.7%. The Russell pairing some of the earlier gains up 0.9%. Really edifying, though, Katie, this idea that the economy is strong. We're not seeing things crack. You're not seeing a sort of slew of people filing for initial jobless claims at a time when the economy is still doing quite well.
That's the thing. I mean, the labor market has just been Teflon strong, and you can see it sort of percolating through the markets right now. The line's deciding where they want to go, but we keep talking about the resilient consumer and the resilient labor market, and it doesn't seem like any of that is really budging as we head into 2024.
That said, and this is interesting to me, especially in light of what we heard from Patrick Harker of the Philadelphia Federal Reserve. The Philadelphia Fed business outlook came out lower than expected, declining 10.5 versus the expectation of the decline of 0.3. So to me, how much is this? Maybe something that different sectors are seeing. Patrick Harker pointing to some of that weakness as part of the reason why he's opting to cut rates next year.
Well, that's the thing. It feels like you can't paint the entire economy with the same brush, that there are pockets of weakness, and then there's pockets of strength. And one of the conversations that I had a lot in 2023 is whether we should be talking about a rolling recession. Maybe we don't see it on a broad economy-wide level, but we have to look to specific industries, specific sectors to actually see the effect of those higher rates.
And we're going to have the broad economic conversation in just a moment, but to talk about the specific sectors and some of the rolling recessions. One of the recessions has been in the logistics area and the shipping area. And I do, before we get to Steve Rasciuto of Mizuho here, I do want to just touch base with Lee Klaskow, senior logistics analyst at Bloomberg Intelligence. And Lee, the reason why you're really the person who I want to speak to is to understand how much we could be dealing with potential supply chain disruptions again because of what we're seeing in the Red Sea.
Yeah, I don't think these are going to be a major dislocation. I think it's going to be more or less a hiccup, if you will. But the net effect is that freight rates are rising. They're actually up about 9% sequentially. A lot of that increase is being driven by freight headed from from China to Europe. That's been up pretty significantly, up around 15-16% over the last week, and it's up around 50% since bottoming in October. But it also does need to remind people that in 2021, to ship a container used to cost $14,000. That was a peak. Today, it's around $1,400. So rates are down significantly, but we are seeing a bounce. And, what's going on in the Red Sea, I'm guessing that it's not going to be long-term in nature, and there's going to be a resolution in the coming months.
Mm-hmm. And Lee, with that in mind, just quickly here, if you anticipate a resolution coming in fairly short order, does this ever touch the consumer, if at all?
Absolutely, because if shippers are paying higher rates, they're going to try to push that cost onto the consumer. But remember, there's a lot of T-shirts that go into a container, so we're talking about a half a penny more in terms of shipping costs to ship certain items. Obviously, larger items, the impact's greater. But a lot of stuff that goes on the ocean are usually lower value stuff, where high value stuff is usually shipped via air freight.
Lee Klaskow of Bloomberg Intelligence, thank you so much for being with us. Short of visit, I do want to get to the economic data that we just got, since it is fascinating to me. Steve Rasciuto here with us, chief economist at Mizuho Securities. And I want to start there. Initial jobless claims came in below expectations. It's actually a positive downside surprise. And yet you're seeing a real rally in the 2-year, which makes me think that the Philadelphia outlook for manufacturing is of concern. Is that right?
Well, I think you have this environment where you have people like you mentioned, Harker, talking about, the grassroots kind of sentiment that they're getting in terms of information from companies that tell them that there's a problem in the underlying economic fabric, but you're not seeing it in the broader macro perspective. I think this gets to what was Katie was talking about in terms of rolling sector recessions, but I think it also gets to the fact that expectations are really an issue, because when I sit down and I talk to CFOs and I talk to CEOs of different companies in different industries, I get the same message over and over again, which is, the economy's not going to do well. We're going to go into a recession, but my business is doing really well. And I kind of like, time out, guys. Everybody tells me exactly the same thing. So if you're all telling me your business is doing well, but you all think the world isn't going to do well, then maybe you've got a disconnect in terms of the underlying realities. And this is why you see the continuing claims numbers doing what they're doing. They're moving lower. So you also see this in terms of the employment numbers. Everyone says, oh, we're laying off workers. But then you go back and look at their actual job counts, and you see that they've repositioned their workers into different parts of their business.
So put this together. Help us understand what's actually going on. Is this basically people are feeling bad because they feel like they should feel bad, and that actually things are very good, and that the risk is actually to an acceleration in the economy that people aren't expecting?
Well, I think the risk is the recession that the market is expecting doesn't happen. You look at things like the blue chip average, right? The blue chip average has first half growth at 0.5%. Now, 0.5% is the closest you're going to get the blue chip numbers to ever saying negative GDP before you actually print negative GDP. So recession is priced into the structure. If you don't get recession, you're going to have a readjustment. This is exactly what happened after the regional bank situation. Remember, everyone forecasted a recession. It didn't happen. Then we had that major summer sell-off. I'm not saying we're going to get as much of a summer sell-off as we got this time through, but there certainly needs to be a correction in some of these markets to reflect the fact that this economy is not rolling over and playing dead, that expectations are different than the reality, and eventually expectations have to adjust to reality, because reality is what it is. It's the reality.
Well, just to meditate a little bit on the evolution of the recession calls. Remember, 2023, it was definitely going to happen. And then everyone started pushing out the recession calls and then basically abandoning them altogether. There's actually a story on the terminal right now. Citigroup, Deutsche Bank, Wells Fargo, some of the last remaining on the street who are still calling for a recession. But just to that idea that maybe rolling recessions are what we're seeing at the sector level, is that the way we should be thinking about this economy, or are we smooth sailing from here?
I think the economy is fundamentally healthy. I think we've discovered that, the Fed is uncomfortable with a 5% 10-year note. I think the Fed is somewhat equally uncomfortable with a 10-year note moving below 4% the way it is. But you have to keep in mind the fair value trading range on the 10-year note, if you assume a 2% target, is basically 3 3/4 to 4 1/4. We're in the bottom half of that range, and no one's going to be selling this market going into the end of the year. There is zero sellers out there, and the bulls are still in favor. So what you're seeing happening on a day like today, where the claims numbers come in lower, continuing claims come in lower, the GDP number probably went down. I don't have the details, but I'm assuming because of inventory.
Yep.
Okay, so those are things that tell you better growth going forward. And then we latch on to the one thing here that we can say, oh, gee, it's time to be bullish again. We'll push, and I think by the end of the day, we'll realize it wasn't worth pushing.
So should we be just applauding the Fed right now? Because you think about what we've seen so far. We've seen inflation come down from once-in-a-generation highs. The unemployment rate is still under 4%. And, I mean, everyone seems to be left and right abandoning their recession calls. Is it safe to say that the plane has just about landed here, that they actually have pulled it off?
Well, the plane was never going to go have a recession. We were never going to have a hard landing. The only way you could have gotten a hard landing is if the equity market corrected to earnings numbers, and then you had companies being forced to really lay off workers to drive up margins. That never happened because the Fed kept on telling you we're going to cut rates. So because the Fed kept on telling you we're going to cut rates, you never had that adjustment take place. So the adjustment in terms of the macroeconomic story is clearly why the Fed did do that through forward guidance. In terms of whether or not they're going to achieve the inflation numbers, that's still open. We're looking at inflation numbers that are closer to 3% than 2%. Now, under average inflation targeting, and given the concept of this Fed in terms of the inflation concept, not wanting to get back to the zero bound at any particular point in time in the future, they're willing to accept 3%. The problem is at 3%, the 10-year note is much too expensive. And if the 10-year note's much too expensive, then the equity market's much too expensive. So the reality is the Fed may get us to a hotter landing, But the markets have to adjust to that, and they haven't.
That's the reason why I was just going to ask you, why are you bearish if you see the economy doing better than expected and no recession? Is this because you do think that there is this inflationary underlying pressure that people are discounting and that there's going to be a meaningful sell-off in bonds as people understand that?
Well, you have to keep in mind there is a global deflationary force which is real incredible. By the same token, there is a domestic cyclical inflationary force that's real incredible. And it's been a battle between the two of them. Markets never took on board the 9% spike in inflation. We never took that on board. So the fact that we've come down to these levels, which are in the fair value range of 2 to 3%, 2%, we have to ask ourselves a question. Is it 2 or is it 3? This is the question we haven't answered yet. And that's the critical question, and that determines whether or not where you want to be in the bond market. And to me, it also suggests that if this Federal Reserve were to do something like take an insurance rate cut, because you hear that conversation all the time. You saw that in 2018, you saw that during the Greenspan soft landing in the mid-1990s. They took these insurance rate cuts. The question was at these particular times, in those particular times, was that inflation hadn't spiked, and we didn't have the cyclical tightness that we have. Today we do. And in 2018, 2019, we had a disruption in financial markets. We have no disruption in financial markets. I think if the Fed were to take insurance rate cuts right now, the dollar would collapse. If the dollar would collapse, you then get into a situation where the global deflationary story no longer helps out the inflationary numbers, because we've been importing global deflation. But if the dollar collapses, we no longer import global deflation. And at that point in time, goods prices no longer go down. If goods prices no longer go down, then service prices are fully reflected in inflation. And that becomes the rub for the Fed. That's why they're in this difficult balancing act of pushing back when things get too aggressive, and when things go too far the other way, they have to push the other way. They're trying to fine-tune this thing. And so far, they've been able to pull it off because the market gives them credibility. You have to ask yourself a question. How many times can you get that lucky?
Steve Risciuto, thank you so much. You'll have to come back on in the new year and tell us whether it's working or not. Steve Risciuto there of Mizuho, as we did get the numbers showing fewer jobless claims than expected, a more robust than expected labor market. Right now, if you are just joining the program, you do see a lift to a market, and it gets even more of a boost following what we saw out of the jobless claims. Yields are lower, and you can see that the S&P futures up 0.9%, up from about 0.5%. Right now, 10-year yields 3.83%, the lowest going back to, I believe, July, going back there.
Yeah, it's pretty amazing. And again, the question of how low can we go, how low should we be, is really at the forefront of the bond market right now. Closer to 380 than 390. Some interesting movement here after those jobless claims. I think you're right. I think it's more the Philly Fed business outlook that's driving things right now, of course, coming in much worse than expected.
Steve Risciuto said something really important that I think we have to sit on for a sec. And this is this idea that people are clinging to the negative, even though there's a lot of positive. The fact that you have initial jobless claims coming in below expectations, continuing claims coming in below expectations. If people are picking up on the Philadelphia Fed business outlook as a reason to sell and to really lean into bonds and to lean into stocks, it gives you a sense people are searching for the weakness that they expect can cool off the inflation without something more material.
Isn't that what bond traders are supposed to do? You know, the doom and gloom guys, they're supposed to find the negative. And take a look at the equity market, certainly finding the positive. S&P 500 futures currently up almost 1%. Again, what we were talking about, what happened at 2:30 yesterday, that sell-off, it seems like a distant memory.
To me, though, I'm just still wrapping my head around this. It's actually, to be pessimistic about the economy is to be optimistic about the market, because it means that you can actually cool down the inflation enough to then restart a cycle. If you don't get that kind of cooling, well, then are we talking about a very different inflationary regime over the long term, or do you just buy in wholesale into the transitory story? This, to me, is the big question heading into 2024. Right now, with a lift, S&P futures up 0.9%. Coming up, a conversation with Brad Rogoff of Barclays as we look to the credit outlook for next year. This is Bloomberg.
I think what really isn't clear is what the Fed's trying to do. They haven't had the impact which perhaps they wanted to have, but at this stage, I still am not sure what impact they wanted. They clearly wanted a rally. Are they trying to fine-tune the extent of the rally that they wanted? Because this is now getting deep into markets and way outside what I think central bankers need to be doing.
That was Sonal Desai, fixed income CIO at Franklin Templeton, trying to push back a little bit on how far the market has gone, concerned about reinflation risk. Right now, markets are not worried about reinflation risk. They are very much risk on, retracing some of the losses from yesterday, maybe not ending on the first weekly loss in 8 weeks, as you were pointing out, Katie.
I think we're going to be okay.
I think we're going to be okay. 0.8% gain on the S&P, 47.88, leaning up toward those record highs. 10-year yields lower, though, on the day after being higher earlier, 3.83%. I quickly just want to mention two names that I'm watching. CarMax came out with their earnings, and they beat expectations, even though sales volumes were down because of used car pricing, how expensive they're able to resell them. And again, this goes to this question of deflation in certain areas that maybe isn't as deflationary as we previously had thought.
Yeah, and it's interesting. You wonder, how much pricing power is left, not just for CarMax, really, but across the economy. Lower volumes, that's been a trend across a lot of retail names, for example, but higher pricing still saving the day. I wonder how much juice is left in that story, though.
Consumer affordability remains the primary headwind, this according to one analyst. So the fact that they were able to sell them the cars at higher prices maybe dents that narrative just a little bit. And Micron shares gaining as a result of reporting better than expected earnings last night, up about 7.6%. I want to get right to our guest, because to me, this is one of the key questions, especially given the fact that we just heard from Peter Scheer that everyone loves credit, him included, considering that a lot of companies termed out their debt. Things look pretty good. The economy is strong. Joining us now, Brad Rogoff, head of FICC, Fixed Income, Currencies and Commodities Research at Barclays. I want to start there. Who is bearish on credit right now?
It's the end of the year. I go around talking about our outlook to a lot of clients. It's really hard to find that person who's very bearish. Now, there are scenarios where credit can widen. And one thing, there's a lot of euphoria right now. You guys have been talking about that all morning, all week, et cetera. But if you kind of go back, and by the way, a lot of it's justified by the economic data. You guys were speaking about that as well. If we go back to 3Q earnings season, right, when we were in the thick of that, not everything was perfect, right? And what you are seeing is in an environment, now it's a little bit less of that environment with the moves we've had in rates recently, but an environment where rates have moved a lot higher, the cost of financing moves a lot higher. If a company misses earnings, the chance of some accidents do increase, right? And when we look at what happened, especially if you look at the high yield market, right, where the risk is obviously greater, and we look at the dispersion between how different bonds traded, throughout the first half of the year, it was actually pretty low, right? That's sensible that there's a macro narrative. If you look in 3Q earnings season, it actually increased quite a bit to a more normal type environment. And I think that shows you that not everything is perfect for every company, but I get the bullish narrative.
I mean, honestly, the fact that Citigroup is getting out of distressed debt trading makes me think that there just isn't enough distressed debt unless it's going to go to private credit, and that's basically where it's going to live. I mean, is that the story that we're looking at right now?
So the private credit phenomenon is very interesting, right? Because it does have these implications on what does it mean for, what I guess we would call the normal historical broadly syndicated loan market or high yield bond market. And it's leading to changes. Both of those markets, right, have actually shrunk this year, meaning the high yield market and the broadly syndicated loan market. Not a crazy amount, but they have shrunk. And private credit has taken some of that. But look, if we look at private credit and what does it mean in 2024, if you are an investor, say, in high yield bonds or leveraged loans, I mean, it's a positive because that is where a lot of the stressed things have gone. I think the estimates are probably over 20 billion of leveraged loans that were all short-term maturities that were lower rated, were refinanced into the private credit market in 2023. A chunk of those would have definitely been defaults at some point over the next couple of years.
That's a really interesting point that basically the problem child's in the public market. Maybe they're heading over to the private market and we'll let those guys deal with that. And with that in mind, I mean, for so long this year, I've just been hearing that this is an up in quality world, that, you want to be in quality names when it comes to credit investing. You said that euphoria is justified. And with that in mind, is this a down in quality environment that we're going into? Are you feeling safe heading out the risk spectrum?
Yeah, as I said, some of that single name stuff I just mentioned where we see you miss earnings and you're really hit means I don't think you can categorically go that way. However, if we look at, say, the high grade market today and you look at where single A bonds are versus where triple B bonds are, those BBB bonds are extremely wide to single A bonds for sort of the level of risk in the market today. So I do think you have to go down in quality there. I think if you looked at the high yield market, probably more of a barbelled approach is appropriate there, because of the idiosyncrasies when you get to really risky high yield names. But you have to do some of that if you want to get some return going forward.
And Barclays is out with its 2024 look ahead. And the first line is that the rally into year end will limit performance from spreads in 2024. And we've been talking about how very tight spreads are. And against that backdrop, is 2024 going to be more about, just clipping coupons, enjoying those high yields versus actual spread compression?
I think so. We got this Christmas present of some extra return in 2023, but it does have to come from somewhere. And I think it comes from next year. And really, and look, there's always two components to returns when you're talking about fixed income and a spread product. You're talking about spreads and rates. And both of them have gone lower recently. And that's not traditionally, if you think back about the history of the fixed income markets, that's not necessarily traditionally how it goes. When both of those come lower, I think you probably wind up looking at, maybe even a slightly lower than coupon type return. Nothing dramatic, but slightly lower than coupon type return as we look at 2024.
Especially because of what we just heard from Steve Ricciuto. Are you concerned that because of the euphoria that we've been talking about, there is going to be a sort of second leg of inflation, that the Fed's going to actually see some of their verbiage work against them with a loosening in financial conditions leading to a stickier inflation that leads to higher yields? Is that something you're gaming out?
Not entirely. I think that higher yields is something we are thinking about. I don't think we think it's because we see another pickup of inflation. I think, do we not see inflation come down as quickly as some in the market are thinking? Yes. And then we look at the rates market today, and we don't really see any term premium in it with what we've seen in the last month. And by the way, if the economy is going to hold up better, that might mean the neutral rate should be higher. And as a result, there should be some term premium, actually. And so when you put that all together, I don't even think you need inflation to pick back up as much as not decelerate as quickly as some are forecasting. And then, rates don't come down. And once again, that's not a tailwind like we've had recently for returns in the market, and maybe even a tiny bit of a headwind.
I want to end where we began. As someone who has to come up with a year ahead outlook, how much harder is it for you to do so when there is such a huge transformation going on in the credit market, with such a huge portion of it going to the private markets, and banks getting in on it, but a lot of it is a lot less visible than some of the public markets, the traditional mainstays and tea leaves for the rest of, frankly, all of markets?
It's definitely harder, but ultimately, when I'm coming out with an outlook for public markets, right, I still have the information on those securities, right? And as I said, when you factor in, and look, we come up with things like default forecasts that, for example, from what we talked about earlier, they might be a little bit too high. Everyone who does a default forecast, what do they base it on? Many factors, but one of them is almost always the senior loan officer survey, or the SLOOS, which no one really knew what that was until this year. Now everyone's obsessed with it, right? After March, yes, exactly. But when you think about that, that's been a very, you can make a nice chart historically that shows that, it shows the default rates, and it seems to predict it quite well. But if a lot of the financing in more difficult situations, as you guys were just saying, is moving to the private credit market, then there's going to be a breakdown a little bit in that correlation, right? Because it's not about bank lending only. So some of that stuff is really difficult. As I said, when we're thinking about returns, I actually think it's a positive, right? Because it's taking away a little bit of your downside.
Brad Rogoff, thank you so much for being with us. Have a wonderful holiday. And we'll see you in the new year in New York. Brad Rogoff of Barclays. If you are just joining us, we are seeing a lift to markets after better than expected economic data, 0.8% gain on the S&P, a little decline on the 10-year. Oil prices just almost 1.5% lower after Angola reportedly is leaving the OPEC union. Katie, this was fun.
This was fun.
Let's do it again tomorrow.
I'll see you then.
Yeah, thanks.
And in about 9 minutes or so.
Yeah, well, we'll see you too then, because this is what it is on a holiday. Coming up on the Open, Emily Rowland of JH Investments, Eric Knudsen of Neuberger Berman, and Monica Defend of the Amundi Institute. From New York, this is Bloomberg.